Cooking. I think we're cooking. Let's go. It's kind of gonna be a sick day. We got J Powell coming in the house. It's go time today. We're gonna get our favorite day of every 6 weeks. The FOMC presser and rate cut decision. And it's also kind of a cool month because this month we're releasing the Reinvest AI, which is really sick. And we've got this huge release schedule for products. We're so excited. But this is the month that we're releasing the product to the public. We're kind of like, I'm excited about it. Like normally I feel like I'd be nervous, but I'm like, no, this is great. So if you haven't locked that in yet, you can always do that. Go to househack.com or reinvest.co, same company. And you could lock in your lifetime membership to that Reinvest AI because once the product's actually out, we're gonna price will go up a lot. But anyway, all right, so let's go ahead and see what's going on. Obviously, we're gonna have some jitters in markets. We got Howard Marks talking about Bublé's. Let's go ahead and take a look at the Is This a Bubble PDF from Howard Marks. We're gonna go ahead and take a peek at that. Let's see here. Oak Tree Clients, Is It a Bubble? By Howard Marks. That's what we're going to start with. And then, of course, we'll kind of watch. You know, we are seeing a little bit of jitters before the Fed. This is very, very normal. You expect to have pre-Fed jitters. I mean, certainly nobody's surprised. At least I believe nobody's surprised in our course member live streams because we know Fed jitter days, this is normal. And we're also paying attention to the latest meme play that I don't think a lot of people are paying attention to just yet. But that's okay, we know about the earnings. Let's go into the Howard Marks bubble piece. Is it a bubble? See what he says. Let's see here. Transformative technology is ascending, and its supporters claim it will forever change the world. To rebuild it requires companies invest money, sums of money unlike anything in living memory. News reports are filled with widespread fears about corporations propping up a bubble that will soon pop. Oh no! Oh boy, not the AI bubble, please! During my visit to Asia and Middle East, I was often asked about the potential about a bubble. And I want to start off with caveats. I'm not active in the stock market. I merely watch it as a barometer of investor psychology. And I'm no techie. So I don't know any more about AI than the generalist investors, but I'll do my best. One of the most interesting aspects of bubbles is their regularity, not in terms of timing, but progression they follow. So, okay, so this is interesting. Basically saying like, hey, bubbles follow patterns, right? Bubbles follow patterns is his argument here, okay? So he says, I got a 300K limit on a credit card. I'm going to spend like there's no tomorrow. Dude, wait a second. If you have a 300K limit, did you know you could go to househack.com, press the little invest button, and you can invest with credit card, ACH, or wires, no fees. Obviously, read the offering circular. I don't advocate you go into debt to invest ever, but you get your 5% yield paid out monthly to you, and there are no fees for investing over at househack.com or reinvest.co, same company. All right, so, but rather the progression they follow, something new and seemingly revolutionary appears. So this is sort of the pattern, okay? So new and revolutionary, let's write down the pattern here. New revolutionary, you know, how about data centers in space? Revolutionary, okay? Then it captures the imagination and excitement by people. Early participants gain big. Okay, so, you know, the people who are early, that's, I feel like, always the case. Early win big. Okay. Then we have those who merely look on, feel envy and regret. Onlookers have regret, that's true. Onlookers have regret. This would be basically FOMO, right? So like, oh man, I should have invested in blah, 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 blah. Okay, motivated by the fear of continuing to miss out, they pile in. That's usually the last leg of the cycle when the FOMO people capitulate. Okay. They do this without knowledge of what the future will bring. The end result for investors is incredibly painful in the short to medium term, though it's possible they end up after years have passed. Okay, interesting. Uh, it's 5% paid out. It's an annual 5%, but you get payments on a monthly basis. So no, it doesn't pay out 5% per month. That'd be crazy, right? And also, that would never be sustainable. Like, if you hear that, you should be like, "There's no way," So that's crazy. Anyway, so because that'd be like what a compounded probably 70-something% annual return, which I mean, an early startup investment could end up doing that, but it certainly would never commit to doing that on a payment method. That'd be crazy. So they do this without the knowledge of what the future will bring. The end result for investors is inevitably painful in the short to medium term. Okay, so that's sort of his pattern. Okay, the FOMO. So basically, the FOMOers who get in late, those who FOMO in late have an incredibly painful short to medium term. Right? Okay. So I've lived through several bubbles and read about others. They all hewed this description, okay? One might think losses experienced when past bubbles pop would discourage the next one, but that hasn't happened, and I'm sure it never will. Memories are short, and prudence and natural risk aversion are no match for the dream of getting rich off of some revolutionary technology that everyone knows will change the world. Yeah, I mean, that's true. It could be the railroad. Brace yourself. All the parallels between what's going on today in AI and all of this parallels, basically, what happened between now, or what's happening now with the railroad boom of the 1860s. Got it. It's a word-for-word applicability. Okay, that doesn't sound great. Before diving into the subject, I want to start with a point of clarification. Is there a bubble? I think there's ambiguity to this. I've concluded there are two different but interrelated bubble possibility. One is behavior within companies, and the other is how investors regard the industry. No ability to sort of judge basically which is which, I suppose. Main job of the analyst, especially in the value school, is to study companies and assets and assess the level of outlook for their intrinsic value. But I think this is mostly for 99% of people kind of a dead art. We do it every day. What I believe is value analysis. We're looking for value, at least the true value of corporations. We do this every day. Like, this morning we did an analysis on a company that I've been thinking has been a meme potential for the last 50% of its price surge, and it still has meme potential. It could still double or even triple from here. And we look at the actual fundamentals of it, and we're like, oh my gosh, they don't have enough cash to pay their bills this year. This is fundamentally bad. The intrinsic value is low, but the meme potential is high. And that's unfortunately the skew here. Today, especially with social media, separating, true value from meme potential is very hard, because people just see stick go up, right? Anyway. Okay, market bubbles aren't caused directly by technological or financial developments. Rather, they're the result of the application of excessive optimism to those developments. Yeah, I totally agree with that. I actually think the SpaceX cash out is such a, the valuation is so high, is such an expensive cash out. I feel like they're trying to basically get their bag before the bubble pops. IMO, they want bag before bubble pops, especially Elon, because he wants to fund his Elon wants the money to beat up people like Sam Altman, whom he obviously calls Scam Altman. But anyway, market bubbles aren't caused by, okay, fine. On technology, bubbles are temporary manias. Temporary manias. That sounds hot. Give me a little crazy. Bubbles will usually coalesce around new financial developments, whether it's the South Sea Company of the early 1700s or the subprime real estate collapse of the last cycle, technological progress like optical fiber in the late 90s, the internet in 98 to 2000. Newness plays a huge part in this. No history can restrain imagination. The future always appears limitless. Well, the future does always appear really fun. Like, it's kind of cool to even just think about robots repairing space stations. You know, like, I think it sounds freaking awesome. So somebody here says, at what point would you say traditional investors had to start taking into consideration the mean value of stocks? Oh, well, I mean, certainly since COVID, right? But I mean, you could make the argument even before that, but I would say that now when you look at a stock, like so I have a rule that for me to buy a fundamental long, like I'll trade a meme play. Meme plays are for trading, right? We should know that. But fundamentals, you actually want the price to go down so you can buy more, right? But a fundamental play, so a meme play is for trading. And what do you want for a meme play? You want upward momentum. That's it. That's all you want for a meme play is upward momentum. And you want to be early. And then you're early to that, okay? A fundamental buy, in my opinion, takes the Rust 2x2 foundation, right? 2x2 foundation. So a fundamental stock, for you to buy something fundamentally, it should have a strong balance sheet and low bankruptcy risk, right? Bullish. It should have strong pricing power. Big PP is bullish, okay? It should have a low valuation, which is bullish. And then, for its growth, because some stocks have a low valuation on a price to earnings ratio, but they have no growth, or they have negative growth, which is bad. And then you should have low momentum, right? Which is bullish. Because I don't want to buy something that's memed up, because then it has high momentum, and then I'm overpaying for it, right? Okay, so role of newness is well described. Okay, short history of financial euphoria. What he called the extreme brevity of financial memory points out the past experience is dismissed. Blah, blah, blah. In other words, history impose a limit, absence of history, everything seems possible, blah, blah, blah. Yeah, I mean, like, to some extent, even Morgan Stanley going, oh, yeah, we're going to, like, I mean, maybe it'll be true, right? But the Morgan Stanley idea that in 25 years, we will create an entirely new United States duplicate GDP of 2025 with robots, like that sounds a little wild, right? It sounds a little like somebody's had a little bit too much, like they've sucked on the juju a little bit too much, right? But, whatever. I mean, maybe that's the problem. Like, how do you fundamentally debate that? Fundamentally debate that, because it's possible, right? So, and then if you're negative, you're just a bear, and nobody likes a bear. Okay. So, bubbles often happen when enthusiasm reaches irrational proportions. So what's the boundary of rationality? I mean, that's the good question, right? The future in the 80s was that we would have flying cars by 2025. Well, I remember being in fifth grade even, and us seeing magazines of flying cars. And so I'm in fifth grade and we're like, wow, I might never have to drive a car. We'll have flying cars. And so I personally remember that being a child. I vividly remember standing at the back of the portable, because I was in a portable classroom. That's what they're called, right? Portables? I can't remember. The little manufactured units, the extra classrooms they have at the back. You always got the back. Standing by the back door, and I'm looking at this like magazine cutout on the wall. I'm like, wow, flying cars, that's so cool. It's crazy. But anyway, something that occurred to me in the past month is the two best calls came in 2000 when I cautioned about what was going on the market for tech, and in 2005 and 2007 when I cited the dearth of risk aversion. So Marx is basically saying his biggest money makers were being cautious against euphoria in .com and 2008, basically. Well, I should say like 2007. Bungalows? You guys call them bungalows? Somebody else calls them detention? Yeah, portables is, I feel like, what we call them. Yeah, anyway. Okay, cool. Bungalows. Huh. First, in either case, I possess any expertise regarding the things that ended up being the subject of bubbles. All I did was render observations regarding the behavior going on. So he didn't care about the fundamentals. He just looked at the behavior. That's interesting. Okay. Second, the value of my calls consisted mostly of describing the folly in that behavior. Described the behavior of insanity, right? Okay. What's good about bubbles? Before discussing AI personally, I would spend a little bit of time on the subject from an academic standpoint for investors. The upside of bubbles. Benefit of bubbles. Let's see here. Useful dichotomy. Financial fads. I've read about it. Witnessed South Sea Company, portfolio insurance, subprime, stirred the imagination. Blah, 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 blah. No thought that subprime would revolutionize housing. It was merely a feeling that there was money to be made. Right. Mean reverting bubbles because there's no expectation that the underlying developments would move forward. Fads merely rise and fall. On the other hand, bubbles on technological progress, as in the case of railroads and the internet, are inflection bubbles. An inflection-driven bubble. So two types of bubbles. So basically, there's type 1, which is a meme bubble with no value. And then type 2 is a tech bubble of progress. Okay, that's cool. I get it. That's a good way to put it. Similar crashes, industrial revolution, railways, electricity, all of them crashed. The automobile, in each case, bubbles were not regrettable, but they were necessary for the installation phase, where it was necessary for not necessarily financially wise investments to lay the groundwork for the deployment period. Basically, the bubble enabled the technology. The bubble helped enable the technology. Okay, so not all bubbles destroy wealth. Mean reversion bubbles, financial miracle, destroy wealth. Okay, got it. So tech bubbles is basically saying tech bubbles net benefit society. I think that's the argument that he's making. Okay, whereas meme bubbles, which he calls mean reversion bubbles, do not. Got it, because they just destroy wealth. They destroy wealth. Got it. Okay. Let's see here. Most novel technology doesn't appear from nothing. Most novel doesn't appear from nothing. Yeah, rather it builds. It builds on previous false starts and failures. Yeah, totally. Bubbles create the opportunity to deploy the necessary capital and fund up the development. Yeah, that's true. So it's actually like, I like this argument. It's basically the argument like, all we're really doing is accelerating AI with this bubble right now. By generating a positive feedback cycle of enthusiasm and investment, bubbles can be net beneficial. Optimism can be a self-fulfilling prophecy. Speculation provides the massive financing needed. That's interesting. The bubble provides the necessary financing, the debt. Yeah. Oh, interesting. Okay. A bubble that could be collective delusion, expression of collective vision. The vision becomes a site of coordination for people and capital for the parallelization of innovation. Instead of happening over time, bursts in progress happen simultaneously. And with mounting enthusiasm comes increased risk tolerance, right? Well, that's always the red flag. Strong network effects. FOMO attracts participants. And like all bubbles, FOMO tends to have a bad reputation, but it's sometimes a healthy instinct. After all, none of us wants to miss out on a life-changing opportunity to build the future. Bubbles based on logical progress are good because they excite investors into pouring money in to carpet bomb a new area of opportunity and jumpstart its exploration. The key realization seems to be that if people remain patient, prudent, analytical, and value insistent, novel technologies will take many years and perhaps decades to build out. Right. It's basically, he's going to argue patience here is what it sounds like. FOMO enables the tech, but patience rewards long-term. That, I believe that's what he's saying. Instead of hysteria, market bubbles caused by the process, to a very short period of time. Life-changing investments in winners, but a lot of it being incinerated. With some of the money going into life-changing... Okay, a lot of money gets incinerated. A lot of money gets incinerated. Yeah, I mean, to some extent, I was talking about Rocket Lab yesterday and in the course member live stream. Here's a company that's got this great potential of being and already is a great space delivery company, but you rely on continuous stock funding because without continuous stock funding, you're screwed. You need to be able to keep raising money. Okay. Technological problem, no desire to throw money away, help bring it about, fine. All right. But Thompson ends this discussion by saying, this is exactly why I'm excited to talk about new technologies. The prospect for which I don't know. I love the fact that he's excited about the future possibilities and at the same time admits the shape of the future is unknown. Okay, assessing the current landscape. Now we get down to the brass tacks. First, I haven't met anyone who doesn't believe artificial intelligence has the potential to be the biggest technological developments of all time. Okay, fine. AI is responsible for a large portion of companies' total capex, fine. I think it's important to know, whereas the gains in AI stocks account for a disproportionate amount of the total gains in stocks, excitement AI injects into markets must have added a lot of appreciation to non-AI stocks as well. Yeah, I kind of believe that. I wouldn't be surprised if there are, frankly, a lot of non-AI companies. I mean, I know today's obviously, a bit of a red day here. But that's leading into the Fed and nervousness. But we've seen breadth actually increase broadly for the Qs since November 21st, right before Thanksgiving. I remember making my buy video around this area. But anyway, the rising tide kind of eventually lifts everyone. Like, I think IWM's actually doing pretty decent. Yeah, that's at all-time highs. 251, look at that. That's all-time highs. So, okay, let's see here. Let's keep going with marks. AI-related stocks have shown astronomical performance led by NVIDIA. Let's see here. What are the areas of uncertainty? I think it's fair to say for a while, we know AI will be a source of incredible change, but we don't know how or what the timing will be. No idea what it will be able to do or how to apply it. Right. Okay, who will be the winners and what will they be worth? If new technology is assumed to be a game changer, Warren Buffett pointed out in 99, the automobile was the most important invention probably first half of the 20th. If you'd seen it at the time, you would have said, this is the place I must be. But of the 2,000 companies, only 3 car companies survived. Autos had an enormous impact on America, but the opposite direction on investors. Oh, that's interesting. Wow. That's a failure rate. 99.85% failure rate in autos. That's wild. In AI, there are some very strong leaders, including some of the world's strongest and richest companies, but new technology is notoriously disruptive. Will today's leaders prevail or give way to upstarts? It's always the question. Similarly, what's a share of an upstart worth? Okay, a team funded by, what is this? Funded by college dropouts raised $120 million, wow, to build a new AI chip to take on NVIDIA. Etched. Okay. ASICs, if Transformers go away, we'll die. But if they stick around, we'll be the biggest company of all time, he told CNBC. This is just an example of basically how there's hope that maybe, startups can compete with some of these massive companies. Okay. Even granting the possibility, I think this is also where Google has an edge. Google also has an edge here. They're competing on the frontier chips, yet are bankrolled by massive subscription cash flows. Like, I think the way you have to look at it is like SaaS cash flows bankroll even bad ideas, right? Like they kind of insulate you from bankruptcy, because worst case, you just lost money on that. But it doesn't bankrupt and take down the rest of the business, right? This is kind of like how, think metaverse, right? Metaverse, totally stupid plan, bankrolled by massive profits. You know, who cares? Meta closes it or scales it back. Move on to the next idea, right? But they don't go bankrupt. Whereas if you were like a metaverse only startup, you'd be screwed. Okay, so even granting the possibility that X won't become the biggest company of all time, if its success is valued at just 1/5 of a mere $1 trillion, what's the probability that would justify a $120 million investment? Assuming for simplicity's sake that the investment was 100% ownership stake, all you need to believe was that achieving a $1 trillion valuation has the probability of 1/10 of 1% for an 8x return of your money. So this is basically just the expected value formula on the potential future valuation, right? That's all they're really doing here. There's nothing wrong with calculating expected value. Oh, that's funny. Yep, see, exactly. Expected value. Leading venture capitalists to engage in this every day, but assumptions regarding the possible payoffs and their possibilities must be reasonable. Right. Will AI produce profits? So this is where he's talking about the reasonableness. Okay, this is what he talked about earlier. Remember, earlier, he said he saw bubbles in analyzing folly, right? In analyzing the ridiculousness of how people calculate things. Okay. Let's see. Two things we know little or nothing about are the profits of AI. Like, basically, is it going to be the users of AI or the vendors of AI? Like, who benefits, right? Will AI be a monopoly or duopoly? The leading companies changing the capabilities? Right. Is it all going to be Google? What is it? Highly competitive free market. Number of firms compete for price on AI services, make it a commodity. Right. Well, I would argue that LLMs will almost certainly be a commodity. And I've been saying that for years. Will almost certainly be a commodity. But it's, what's not a commodity is your integrators, like, Google Workspace, I don't know, example, maybe even UiPath as an integrator, Salesforce as an integrator. They win if LLMs equal commodity, presumably, because it just lowers their cost of business, right? There we go. Okay, cool. Or perhaps will it be a mix of leading companies and specialized players? That said, services currently respond to AI inquiries. GPT, Gemini lose money on every query. Leading tech firms, winner take, all markets, tend to be content to fund losses. Hundreds of billions of dollars being committed to the AI race for leadership. Who will win? Likewise, the AI's impact. Clearly, AI will be a great tool for enhancing user productivity, replacing workers with computer-sourced labor and intelligence. But the ability to cut costs to add to profit margins is questioned. Okay, fine. Should we worry about so-called circular deals? Well, let's see. The dot-com boom of the late 90s, optic fiber became overbuilt. If two companies own fiber, they have assets on their books. But if each company buys from each other, they both report profits, and so they did. Right. That's actually a funny thing. Okay, so I want to make like a personal example here. There's not trying to make a pitch or anything. Okay, but personal example. When Househack buys a $600,000, or let's call it a $800,000 house for $600,000, and we put $40K, call it probably $60K in, we're up $140,000, right? But the balance sheet doesn't show that profit. Or the balance sheet, first of all, the balance sheet doesn't show that. So two things. One, balance sheet won't show the extra 140. Two, P&L won't show the extra 140. It's sort of like it's there. We know it's there because of the comps, but you're not paying, and the benefit is like, we know it's there and we're not paying taxes on it, but you can't really show that to people, right? This is the argument he's making. And so circular deals, like selling, these appreciated assets, make those gains real. And then you pay taxes on them, right? You pay taxes, and this, but show them on P&L, which equals, revenue up, right? And this, hold on, I gotta close it. It's all the baby. Right? Oh, that was loud. You may not have heard it because I have a silencer on. But anyway, it's actually really interesting, right? So this is what they're talking about with these circular deals at companies. See, that's what he's saying. If two companies own fiber, they have assets on their books, right? That's like what I'm saying with this example with HouseHack. We go buy a really good deal. We're up 140K on the deal we buy. We don't show that as profits. It doesn't even show up on our balance sheet in this case because you don't mark to market a real estate asset. So we know it's there, but the way to make it show up is you go sell it to somebody else and then lease it back or whatever. Now it becomes a real number, and that's where you get circular deals. And to me, I think there's risk in that. It looks great on a balance sheet, but there's risk in that. It actually, to some extent, it might be sort of like, to some extent, Carvana. To some extent, Carvana sells those, balance sheet assets to realize the gains to the founder's own company, which pumps the stock, which they sell to fund their own purchases, right? Like Carvana is the perfect example of this circularness that Howard Marks is talking about. It's quite literally a perfect example of this. Okay, so very interesting. The silencer didn't work. Oh, you still hear it? Yeah, it was loud. It was loud. Nowadays, deals are being announced in which money appears to be round-tripping between AI players. Exactly. Round-tripping between AI players. I'd probably make that orange. Oops. It doesn't matter. There we go. People who believe there's an AI bubble find it easy to view these transactions with suspicion. Is the purpose to achieve a legitimate business goal or to exaggerate the process? Adding to worries is that some of the deals OpenAI has are oddly circular. OpenAI is set to receive billions from tech companies, but send billions back to the companies to pay for computing power. Right. I mean, think about it like this. NVIDIA invests into OpenAI. OpenAI spends on NVIDIA chips and AMD chips. AMD gives shares of AMD to OpenAI, who benefits off rising valuations and spends more on chips. Like, it's kind of a perfect example of the circular insanity that's going on. So, I mean, Howard Marks so far, he's kind of right, very interesting. Oh, just for like disclaimer sake, okay, get that out of the way really quickly. There's risk with every investment. This isn't a solicitation. Read the offering circular at HouseHack. I was using HouseHack as an example here to help people understand how balance sheets and like circular financing work. Like, we don't do that, but we're saying like you could. Like, if I had a sister company and I bought and paid market value for all of the houses HouseHack was buying, HouseHack would look like it's making this huge amount of money, which is great. Like, you could totally do that because the value of the properties, the assets are actually worth more. That's why there's that incentive to do that, because then you pump that revenue number, right? It's very interesting. NVIDIA has also made some deals that raise questions about whether the company is paying itself. It announced it would invest, here it is, $100 billion into OpenAI. The startup receives money and then buys, releases NVIDIA chips. Right. Yeah. Goldman Sachs has estimated NVIDIA will make 15% of its sales next year from what it calls circular deals. Wow. 15% of NVIDIA revenue from circular deals. Wow. Yeah, somebody says, did you talk about the SpaceX IPO? Like, I don't understand. Does YouTube not, like, show you the videos? Like, obviously you see the live stream, but, like, I literally made this video yesterday. The next 10x in stocks, Elon Musk, and it's got SpaceX in, like, the logo for Elon there, you know? We literally talked about that yesterday. If you search, like, me, Kevin, SpaceX, it comes up, too, because it's in the tags. But anyway, it's a great video. Really good, detailed video there. But anyway, so notably, OpenAI has made investment commitments to industry counterparties totaling $1.4 trillion, even though it has yet to turn a profit. The company makes it clear that investments are to be paid out of revenues received from the same parties. But it raises the question about whether AI is developed into a perpetual motion machine. Yeah, fair. Somebody says, we didn't get the notification. Well, okay, so just so you know, YouTube will not send you all of the notifications, okay? I just want to make this blunt. You might be clicking the button and you might be like, but Kevin, I pressed the button that says, I want all notifications. Okay, yes, old news. We know that. You can literally press the button that says, I want all the notifications, and YouTube will basically give you a middle finger. They will only give you 3 notifications within a 24-hour period, which means if it's like, Kevin's about to go live, Kevin's live, Kevin posted a video, you're not going to get another notification for the next 24 hours. Maybe you don't want another notification for the next 24 hours, but this is exactly why, and you could download it for free, we made the Meet Kevin app. So you could download the Meet Kevin app and you could literally check, I want the daily wealth, or I don't want the daily wealth. I want alpha reports if you're a course member, right? I want the stock reports if you're a course member, or I don't, right? I want these playlist notifications, like I want Kevin's Federal Reserve videos, or Trump videos, or California videos, or whatever. That's why we made the Meet Kevin app, so you could customize your notifications and you could choose what you want. What's also really cool is we've got the coming soon page for Reinvest AI, which means we can toggle on, people's access to this manually and soon automatically. But like, it's there. The Reinvest AI is in it. It's really exciting. So you download the Meet Kevin app or the Reinvest thing. It's all in the same app. It's all one app. It's kind of cool. All right, anyway, so where were we here with Howard Marks? Notably, OpenAI has made investment commitments to industry counterparties totaling $1.4 trillion. Right, this is insane. This is, as I've said, the greatest risk, right, is Sam Altman going BK. Sam going bankrupt. All right, that's the biggest risk. Okay, then we have... notably, OpenAI has made investment commitments, $1.4 trillion, yet to turn a profit. The company makes clear that the investments are to be paid out of revenues received from the same parties that it has ways to back out of these commitments, but that all raises the question about whether the AI industry has developed a perpetual motion machine. Yeah, that's a really good point. Somebody says Sam Altman creeps me out. And it kind of creeps me out as well. Like, that murder interview with Tucker Carlson was scary. How do we get the videos that you make before you go live on YouTube for course members? Those are the course member live streams. So right now we have those come out under the Alpha Report tab. So when I do my Alpha Reports in that same tab, under Alpha Report, we'll have the course member live stream. I'd show it, but it shows my last buy and our Alpha Report and some notes and stuff. But basically, it's just a little tab for it. But yeah, somebody's right. The Christmas tree does break. I put a little Christmas tree in the Alpha Report for our course member special. And in text edit, it shows fine, but in the app, it breaks. But all right, anyway. No Christmas tree. It's an ASCII Christmas tree. Okay, so $1 billion is a dollar a second for 31 years. $1 million is a dollar a second for 11 days. Oh, this is interesting. $1 million is a dollar a second for 11 days. $1 billion is a dollar a second for 31 years. But $1 trillion is a dollar a second for 31,000 years. Wow. That's a great way, by the way, to showcase this. Notebook LM from Gemini is the Game Changer. What is that? Notebook LM. Somebody says gay pride flag. I stand with you, Sam. I mean, I don't see any issue with somebody being gay. I think the issue is, has he had too much of the Kool-Aid, right? What's Notebook? Your AI-powered research partner. Upload sources. Upload PDFs, website, YouTube videos, audio files, Google Docs. The problem with these, and the reason I don't use stuff like this, is you have to be really careful summarizing stuff because you won't learn. And that's, so this, researchers have found this as well. If you're not actively thinking about the act of researching, you don't make the synapses. You don't make those wired mental connections in your brain. I actually think watching YouTube videos and seeing that mental thinking happen together helps you make those connections, those memories in your brain. If you just summarize everything, you get this cute little bullet point report, you're like, wow, cool, and then you file it away. You're gonna forget all of it. Like, you don't actually learn from doing that. You don't become intuitive. You become reliant on a machine. So I'm typically, I mean, is it just a way to sort of like fight Notion? I hate Notion, by the way. Like, I think people make too many Notion subfolders and just bury stuff. It's crazy. Shared notes. Yeah. Whatever. Okay. So let's keep going with the Howard Marks. So what do we have here? What will be useful in AI assets? We have to wonder whether the topic of obsolescence is being handled correctly in AI land. What will the lifespan of AI chips be? Somebody here says, agreed, when studying for the MLO right now. Oh, by the way, really smart, by the way, to become an MLO. I actually, I feel like everybody should do this. Like, get your lending license. Because if we go into recession, we will come out of that recession in the greatest lending and borrowing boom I think we've ever seen in generations. And you can make a lot of money being a lender. It sucks right now, but that's the point. You want to start a lending business or like get ready to start a lending business closer to the bottom. So, but anyway, you write, I opted to read a textbook instead of using an AI generated podcast like some of those sites provide. Yeah. It's all about learning. You have to actually digest. That's why I do this. I mean, dude, look at this. Look at all these highlights and these notes and stuff like that. The way we go through this together, I think, is valuable. And when I give these examples, I think that the whole purpose is to understand and learn and relate. If you put this all into a summary, the summary generation you'd get would be bullcrap. Howard Marks is worried about an AI bubble because while AI bubbles can be good because they can accelerate and provide the necessary funding, he gives the example that 99% of auto companies end up winning and bankrupt. It's like, you take away from, who cares? All right, anyway, sorry, enough ranting. What will be the useful life of AI assets? Okay, so this is the Burry piece. So now we're getting into Burry. Kev, we haven't had a recession since 2009. Well, technically we had a short recession there during COVID, and we had a technical recession in 2022. So, any tips on the SIE? The SIE should be able to slam dunk. It has one of the highest pass rates, but flashcards, man, flashcards. Is the House Hack AI app going to be Android as well? Yes. Yes, Android and iOS. So somebody says, do you do a monthly subscription for the Alpha Report? You know, most of my audience does not like monthly subscriptions. I think there's a monthly option in the app when you download the app, but it's very expensive, and most people end up just doing the lifetime access at meetkevin.com, or people who want the Reinvest AI, they just get that at househack.com. But anyway, we have to wonder whether the topic of obsolescence is being handled correctly. What is the lifespan of AI chips? Blah, 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 blah. Okay. A single issue newsletter briefly mentioned 2 developments that suggest the fluid nature. A study by MIT found that downloads of the Chinese-made models rose 17% in the past year. The figure surpasses the 15.8% by American developers. Okay. NVIDIA shares fell sharply on fears Google is gaining ground in artificial intelligence. Okay. So dynamic change creates the opportunity for incredible new technology, but that dynamism can threaten leading companies. Right. Okay. So basically, new innovation can kill the current leader, right? Like NVIDIA with new chips. And then collapse depreciation schedules. That's fair. I think that's totally fair. Okay. So, for an extreme example, I'll cite the trend towards venture capital investments in startups via $1 billion seed rounds. This is insane, by the way. Like, $1 billion seed rounds, oh my gosh, they're throwing this money around like crazy. You know, venture capital money blows on billion-dollar seeds is insane. Like, you know, just for giggles, the House Hack seed round equaled $1 for every $1 of cash we had. So, you know, basically raised 50 million at a $50 million valuation, right? $1 to $1. What these companies do, for contrast, these seed rounds raise $50 million at a $1 billion valuation, which instantly at these AI companies, instantly dilutes shareholders. 50 divided by 1,000, 95% shareholder cash. So basically, every dollar you put in, you're really only generating like 5 cents worth of cash value. It's insane. So, you know, we decided we're not going to do that when we raised for House Hack, and we still don't do that. You know, we think what we're raising at the August 2024 valuation at $1.40 a share, basically. And, you know, that's like so massively different than this, because, you know, that's the low end of what the book value multiple is that we got from the Wall Street firm. Anyway, this is how the blah, blah, okay, Derek Thompson, but that's ancient history, 2 months old. Here's an update. Marathi in talks to raise it, but that's oh my gosh, that's ancient history. Marathi from OpenAI is raising at $50 billion after it originally raised at $12 billion in July and raised $2 billion. That's insane. Just simply because she worked at OpenAI. It's crazy. That's like this is insanity. And that's what Howard Marks is getting at. Remember, he said you look for folly. Okay? That's what this kind of stuff is. It's folly. Thinking Labs. All right, what do we have here? Thinking Labs machine isn't alone. It's one of the boldest bets in AI. Safe Superintelligence, SSI, the stealth startup founded by Ilya, raised $2 billion, and around that values the company at $32 billion, despite having no publicly released product or service. Yeah. Literally has nothing, but the guy worked at OpenAI and raises $2 billion. Insane. That is what is called insane. By the way, let's go see how the market's doing right now. IWM's up. The Qs are doing okay. Look at that nice little V-shaped recovery here. You know, you've got some level of nervousness pre-Fed. This is just very, very typical, very normal to see this. Ethereum's holding on to 33, Google 318. What do we got here? Oh, Caterpillar's up almost 2%. But anyway, all right. Let's go back to that doc. This is a great piece by Howard Marks. Great piece so far. So part of the issue with AI includes the unusual nature of its newest thing. This isn't like a business that designs and sells a product, making money if the selling price exceeds the cost of inputs. Rather, it's companies building an airplane while it's in flight. And once it's built, they'll know what it can do and whether it can pay for its services. Right. That sounds irrational, right? But it's kind of true. Sounds irrational. Many companies justify their spending because they're not building a product. They're creating something that will change the world. Artificial general intelligence, that's bullcrap. AGI. AGI is BS. Spending would be justified if Silicon Valley reached its goals. He's optimistic that can be done. It's a bet that it's AGI or bust. Well, all right then. Yet to be determined nature of the industry under construction is best captured from Sam Altman. We'll build this sort of generally intelligent system and figure out a way to generate an investment return for it. Oh my God. That sounds, again, sounds retarded. And that's the point of Howard Marks's letter. Like, this is stupid. This should be the source of pause for people who fully comprehend the nature of the businesses they invested in. Clearly, the value of technology that equals or surpasses the human brain should be pretty big, but isn't it well beyond calculation? A word about the use of debt. Yes. Okay, here we go. Hence why Househack has no bank debt. Too risky right now. All right. And Kevin has zero personal debt. Today, much of the investment in AI and supporting infrastructure has consisted of equity capital derived from operating cash flow. But now companies are committing amounts that require debt financing. And for some of these companies, the investments and leverage have to be described as aggressive. Yeah. The AI data center boom was never going to be financed with cash alone. The project is too big to be paid out of pocket. JP Morgan analysts have done some sums on the back of a napkin, possibly tablecloth, that an estimated bill for the infrastructure build out would come up to $5 trillion. Right. And meanwhile, Microsoft, Amazon, Meta, Oracle only have $350 billion in the bank. Infrastructure build out's going to cost $5 trillion. Right. Where's that going to come from? The difference comes from debt, baby. The spread? Debt. Thanks to people like Blue Owl Capital. Okay. The firms mentioned above derive healthy cash flows from their very strong non-business AI business. Exactly. That's the benefit. That's the hedge at Google Meta. But the massive winner takes all arms race in AI is requiring some debt. In fact, it's reasonable to think one of the reasons they're spending vast sums of money is to make it hard for lesser firms to keep up. Oracle, Alphabet, they've issued 30-year bonds. In the case of the latter two, Meta and Alphabet, the yields and bonds have exceeded those of treasuries by 100 basis points or less. Is it prudent to accept 30 years of uncertainty with a little more yield than riskless debt? Right. Market is taking a 30-year risk with small premium over risk-free debt. Again, he's arguing that this is folly, aka this is stupid, is his argument, right? Okay. But I think it's very hard for people to imagine Google and Meta like going bankrupt, right? So what do you think of the folks who go by the buy, borrow, die approach? I guess I don't really know what you mean by that. I mean, buy, borrow, die, like go bankrupt. Like I think people going through those cycles, it's kind of a scam. Like I think of who's the WeWork guy? Like the WeWork guy, in my opinion, is a terrible investor and terrible business leader. Yet because he knows people, he can bankrupt one business, then start up a new business and raise $300 million and raise $300 million for Flow, a random idea. Flow, a random new untested idea. The scam keeps going. It's insane. Adam Newman, that guy. I call him the WeWork guy. Adam Newman. So is there any news on this? Let me see. I don't think there is. Yeah, I don't think it's done anything yet. Flow.life. Oh, they made a nice, cute little website. Life in Flow. Is that the right one? That looks right. Oh, well, they made a little website. That's fair. A Flow house. Mission values. Rent. So they put some of the money into some buildings. And the idea that they wanted to do was they wanted to make some kind of like community and have like some crypto involved. I don't remember all the details of it, but it's crazy to me. So anyway, okay. So then we have, let's focus on Howard Marks. So Howard Marks, it's prudent to accept 30. Okay, yeah, we talked about that. Let's see. Primarily regarding the use of debt in the AI sector, here's what someone said. Healthy behavior is practiced by reasonable, thoughtful business leaders, like the ones at Microsoft, Amazon, Google, that are making sound investments in growing AI capacity. They all have customers, and so when they make investments, they're using cash on their balance sheets, and they have tremendous cash to back it up. That's the benefit. Like, that's the saving grace. Unhealthy behavior is a startup borrowing money. I agree with this, by the way. So that's healthy behavior. Totally agree. Unhealthy behavior is a startup borrowing money to build data centers for another startup. Yes, this would be like your NBIS, IREN, CoreWeave, IMO future bag holders, but that have momentum now, with momentum today. Okay. So yeah, they're somehow being able to raise debt capital in order to fund this build out, again, without having customers or visibility. Well, in fairness, these do have customers. So I would say to some extent, borrowing to fund other AI companies. And then, I mean, yeah, okay, all right. So I'll leave them like this. I'll put them right here. Okay, cool. So there's a whole range of behaviors between healthy and unhealthy. We just need to sort that out and not make the mistakes of the past. There's certain things we finance through equity, through ownership, and other things we finance through debt. As a society, for the longest time, if the two pieces in the right place, debt is when I have predictable cash flows to back the loan. Look at this. Debt. So they make the argument, and they basically say debt for predictable cash flow, equity for uncertain speculation. Interesting. And they say danger is confusing those. Okay, that's interesting. Speculative asset. We don't know how much of it we're really going to need in 2 to 5 years. Lender, personnel with incentives to make loans, but no long-term exposure. Right, these are long-term issues. Possibility of the supply that AI capacity catches up to surpass demand. That's a totally real risk. Because supply catches up, this kills depreciation. kills depreciation curves. This is Sam Altman. Build it idea and spend infinite money. Okay. The chance that future generations will be more powerful, obsoleting existing ones, powerful competitors. Right. Okay, got it. Here's some important points from another article. When does the AI boom pop into a bubble? Inflection point when credit expansion exhausts. Aha. And starts chasing better ones, funding marginal deals with vendor financing. Right. So basically, the bubble shifts when good credit isn't possible anymore. Need bad credit and bad credit financing bad deals and circular vendor financing. I mean, some of that we're already seeing. Paul makes a compelling case. We've entered into the speculative financing territory. Yeah, I agree with that with OpenAI for sure. As Paul warns, the financing will create templates for future transactions, spurring rapid expansion into junk issuance and SPV proliferation amongst hyperscalers chasing dominance, aka Blue Owl funding Meta $27 billion data centers, while Meta has escape clauses. And Blue Owl holds the bag. For AI infrastructures, the warning signs are flashing. Vendor financing proliferates. Coverage ratios are thin. Yeah, because how is OpenAI going to pay for all of it, right? OpenAI can't afford this. That's true. It's a good point. We see both sides genuine infrastructure expansion alongside financing gymnastics that recall the 2000 bubble burst. But the boom is yet to prove productive, but only if revenue catches up before credit tightens. When does healthy strain become systemic risk? The question we must answer before the market does. Off-sheet balance financing. Yeah, this is basically a talk about Meta right here. Yeah. Off-balance sheet financing and special purpose vehicles were exactly what you had with Enron. The parent company may have operating control because it doesn't have majority ownership. It doesn't consolidate the SPV on its financial statements. The SPV takes on debt, but the debt doesn't appear on the parent's books. The parent may be an investment-grade borrower, but likewise, the debt isn't an obligation of the parent or guaranteed by it. In today's debt may be backed by the promise of rent from data center tenants, but the debt isn't the direct obligation of the equity partner either. Essentially, the SPV is a way to make it look like the company isn't doing things the SPV is doing and doesn't have the debt the SPV does. Right. AKA the Meta deal. Okay. Would enable deployment period were money-losing investments. Early investment is lost in the Minsky moment. Okay. Magnifies losses if there are losses. Right. Some losses amplify other losses. Increasing probability of a venture failing if it encounters a difficult moment. Yes. Difficult layer of equity beneath. Lender's capital at risk. One key risk to consider is the possibility that the boom in data center construction will result in a glut. Oh, 100%. 100%. That's also the biggest risk of this, space data center idea. Which is basically that we will have so many data centers that we don't need all this crap. Greatest risk is we end up with too many data centers. And everything collapses then. New generation of owners might end up buying data centers for pennies on the dollar. Yes. From lenders that foreclose on them, reaping the profits when the industry stabilizes. I mean, that's what we should do. We should start data center hack. And we only buy together data centers out of foreclosure. Data center stakes out of foreclosure. That's what we need. Data center hack. Okay. So let's see here. Dude is, let's see. Likewise, leverage of the distribution comes down to the proportion of debt to capital structure, margin of safety. Worth noting that Oaktree has made a few investments in data centers, and they're raising money. So, worth noting, Oaktree has made a few investments in data center, and our parent is raising $10 billion to fund AI infrastructure. Brookfield is putting up its own money and equity commitments from sovereign wealth funds and NVIDIA, which intends to apply prudent debt. Brookfield's investments seem likely to go largely into geographies that are less saturated with data centers. That's what they're arguing. Like, of course, we're both doing these things on the basis of what we think are prudent decisions. So basically, acknowledging they're part of the very bubble they're warning about. Now, like, how do you reconcile that? Well, that's the nature of the craziness. That's the problem. If you're a money manager, you can't not be a part of it. You kind of have to be a part of the bubble, which is kind of crazy. Let's see here. Our parent company, Brookfield. All right, anyway. Financial Times unhedged quotes, blah, blah, blah. In our conversations, often cited concern about the residual value risk of data centers when the bonds mature. I'm glad they're asking. Intersection of debt and AI. Most technological advances develop into winner takes all or winner takes most competitions. The right way to play this dynamic is through equity, not debt. That's their argument. Assuming you diversify your equity exposures to include the eventual winner, the massive gain from the winner will be more than enough to compensate for the losers. Basically, diversify, don't have debt, and try to capture the winner. Okay. Precisely the opposite is true of diversified pools of debt exposures. You only make your coupon on the winner, and that will be grossly insufficient. Okay, basically, data center bonds are the greatest risk, basically. Coupon plus return of capital isn't great upside. Right, because like you get your money back plus a coupon, but if you don't have any of the upside, it sucks, right? Like that's the thing, like when people invest in Househack right now, they get 100% of the stock upside, whatever that is. That's different from data center bonds. Like data center bonds, you're getting a yield, but you're not getting that upside. That's a good point. Trying to get to a conclusion, there can be no doubt that today's behavior is speculative. Defined as based on speculation regarding the future. There's also no doubt that no one knows what there's no doubt that no one knows what the future holds. But investors are betting on huge sums of the future. I want to say a little bit about the unique nature of AI evolution. The AI revolution is different. Oh, this time's different. It feels to me like a genie has been released from a bottle and it's not going back in. AI may not be a tool for mankind, but rather something of a replacement because it's capable of taking over cognition. I don't know about that. Because of this, it's likely to be different from prior developments, not just a degree. AI technology is progressing at a rapid clip. Scant time for mankind to adjust. Coding is the canary in the coal mine in terms of the impact of AI. In many advanced software teams, developers no longer write code, they type in what they want. And AI systems generate the code. Coding performed by AI is at a world-class level, something that wasn't true years ago. According to my guide here, there's no speculation about whether or not human replacement will take place on that vertical. In the field of digital advertising, AI engages ad matching, right? No humans need to do this job. I mean, this ad matching thing, this is true. This is true, and why Google and Meta are likely huge winners in AI ads. Oh, and Meta. and Meta, or sorry, and Netflix, Disney, sort of like the content companies, right? Yeah, that's very interesting. Okay. SpaceX plans to use an upgraded version of its Starlink satellites to host AI computing payloads. Oh, that's cute. Bezos and Musk race to bring data centers to space. Yeah. Limited time offer. Trade crypto at just 0.03%. Man, it's a scam. I don't want your debt. Why do you have to leave me a voicemail? Like, I don't understand. Like, why can't you just send me an email? No email. And call them really quick. I gotta talk to Maria. We'll keep going. I don't know the freaking extension. I'm gonna guess. Press 1. This is dumb. Dude, I ain't doing this shit. Send me an email. So dumb. All right. Perhaps most importantly, the growth of demand for AI seems totally unpredictable. As one of my younger advisors explained, the speed and scale of improvement mean it's incredibly hard to focus on demand for AI. Adoption today means nothing to do with adoption tomorrow, because a year or two from now, AI may be able to 10x or 100x what we could do today. Thus, how can anyone say many data centers will be needed? Like basically, how can you determine? Let me see if I can like text or email this person really quick. This isn't that hard. It's just these people, like, who leaves voicemails? Like, people have jobs to do. Why? Send me an email. It's not that hard. Just lawyers title. There. Okay, I found the email chain. But this is from 5 days ago. Received voicemail. Can't, tried calling back and got phone tree. Yes, we're good to release the recording. There. Send. Drives me absolutely nuts. It's so old school. Like, hey, this property you guys bought and signed a contract for and wired all your money for, and the closing estimate that you already signed. We just want to make sure. Do you really want to buy the property? Yes! Like, it's not that hard. Oh, sorry. I hate that stuff. Anyway. Thus, how can anyone say how many data centers will be needed to release the files? Exactly. With differences like these, how can anyone correctly judge? Yeah, no one can. Right, you can't. Okay. Let's see. One of the things occupying many observers at this juncture, including me, is the search for parallels to past bubbles. RCA bubble. That's the comparison. 1919. Okay, so it's immediately clear that it had a powerful information technology understand, but what was less clear is what it would translate into. Would radio be a loss-leading marketing for department stores, a public service for broadcast, ad-supported medium for entertainment? What was it going to be? All were possible. As a result, radio turned into one of the biggest bubbles in history, peaking in 1929 before losing 97% of its value. Wow, 97% decline. That's crazy. became an enormous GPT. What is this? Charles Lindbergh flew the first solo nonstop transatlantic flight from New York to Paris. It was a big demo, became a big ChatGPT level coordinating event, a signal to pour money into aviation, basically. And then the bubble burst. Aviation stocks dropped 96%. Wow, dude. Minus 96%. Those are insane levels. 97% decline, 96% decline. Wow. It's worth reiterating that two of the closest analogs AI seems to have in the tech bubble history are aviation and broadcast radio. Oh, great. Both were wrapped into high degrees of uncertainty and hyped. Both were seized on by pure play companies seeking to capitalize on new game-changing tech. Both helped inflate the bubble so big that when it burst, it left us with the Great Depression. Yeah, well, that's the problem. Like, the terror of a collapse of AI now that's worse than prior crashes. Okay, you ready for this? This is, in my opinion, a big deal. You should already know about this if you've been watching my videos, but the terror of a collapse of AI that actually makes it worse than prior collapses is that prior collapses were fixed by money printing that did what? By money printing that created jobs. Think Works Progress Administration to hire people. Think QE Infinity for businesses to hire people, okay? AI literally is the antithesis of hiring people, okay? That's the scary thing. So we got out of the Great Depression through hiring. Solved Great Depression by hiring. Solved Great Recession by hiring. Okay? This is the thing that scares the SH9T out of me. How do you solve the AI recession? That sucks, dude. Because when people get nuked, that's the labor recovery will be generationally slow and massively painful. We could lose a generation of like stock returns. Which is that's the scariest thing about the bubble pop. This is what we hope doesn't happen. We don't want this, right? Okay, cool. So, railroads were a bubble that transformed America. Electricity were a bubble. Broadband was a bubble. I'm not rooting for a bubble. Quite the contrary. I hope the economy doesn't experience a recession. I'm the same way. This is like, it's almost like he's watching my videos. He watches my videos and then writes his letter. And then I read the letter and I'm like, see? But given the amount of debt now flowing into AI data center construction, I think it's unlikely that AI will be the first transformative technology that isn't overbuilt. Totally agree. It will get overbuilt. And doesn't incur a brief, painful correction. Hopefully it's brief. The correction will come one day. The length of that correction, I think, is the bigger problem. Okay? So, the skeptics are ready to cite these things. Roll FOMO, circular deals, SPVs, billion-dollar seed rounds. Yeah, this stuff is insane. Supporters have reasons why the comparison isn't appropriate. Users of AI. Yeah, but a lot of people don't pay for AI. Like, how many of you pay for AI? The last time we ran for this survey, it was like 80% of you don't pay for AI. Because it's like there's so many free chatbots, right? I'll elaborate regarding the first of the proposed non-comparable factors. Unlike the internet bubble, AI products already exist at scales. Demand for them is exploding. This is true. Anthropic is producing revenues. Anthropic is said to have 10x its revenues within the last 10 years. That's 100x in 2 years. Claude coding program, annual run rate, said to be at an annual run rate of $1 billion. Cursor as well. Final bullet point comes from Goldman Sachs. You'll notice that during the internet bubble of 1998 to 2000, PE ratios were much higher for Microsoft, Cisco, and Oracle than they are for today's biggest players. Right, that is also true. Let's see here. Okay. In fact, Microsoft on a half off sale relative to its valuation last year. Fun fact. Yeah. In the first bubble I've witnessed in the 50s, PE ratios for leading companies were higher than those of the 2000s. Yeah, this is a fair counterpoint. NVIDIA, on a fair fundamental basis, should be trading for $300. It's trading for a discount to its fair value, suggesting there's some limit to the euphoria. Well, I mean, there's really no euphoria, just broadly in the AI euphoria. Okay, AI bubble will be solved by World War III? I don't. Well, I guess everybody gets a job holding a gun, huh? Unless the robots take over and do that for us, too. All right, so what do we have here? But do I have a bottom line? Yes, I do. Alan Greenspan's phase mentioned earlier serves an excellent way to sum it up. Irrational exuberance, okay? There's no doubt that investors are applying exuberance with regard to AI. The question is it irrational? Given the vast potential of AI, but also a large number of enormous unknowns, I think virtually no one can say for sure. We can theorize about whether the current enthusiasm is excessive, but we won't know from years from now. Bubbles are best identified in retrospect. Who knows? Good one. Good one, Howard Marks. While the perils to past bubbles are inescapable, believers in technology will argue this time is different. Those 4 words are heard in every bubble. Yes. This is true. It's never different. Okay. But on the third hand, it must be borne in mind that behavior based on the belief is different from what it causes not to be different. Borne in mind, the behavior based on the belief that it's different is what causes it not to be different. Right. Today's situation, for those who believe, no proof is necessary. For those who don't believe, no proof is possible. This is like Bitcoin or God. This is like Bitcoin or originally, meant for God and faith, right? For those who believe, no proof is necessary. For those who don't believe, no proof is possible. Like no proof will convince Peter Schiff, as an example. Right? Actual bottom line. So here's my actual bottom line. There's a consistent theory of history of transformative technology generating excessive enthusiasm. The excesses accelerate on the adoption of technology in a way that wouldn't occur in their absence. This common word for that excess is bubbles. AI has the potential to be the greatest transformations of all time. If enthusiasm doesn't produce a bubble conforming to historical patterns, this will be a first. Okay, basically, if this isn't a bubble, it'll be a first. AKA, it's probably a bubble, okay? And we don't want it to burst anytime soon. Okay. Bubbles, let's see here. The losses stem largely from the fact that technology's newness renders the extended timing of its impact unpredictable. This in turn makes it easy to judge companies too positively amid the enthusiasm and difficult to know which will emerge as winners. There can be no way to participate fully in the potential benefits from new technology without being exposed to the losses that will arise if enthusiasm proves to be excessive. Right. Basically, no way to be part of the good without accepting the risk of the bad. However, you could limit the debt, right? The use in debt in this process I think this is why he says diversify and limit debt. I totally agree with that. Like, that's what I think is so interesting. For example, like I just give, because I always go back to this, but I think House Hack, backed by real estate, no bank debt, and cash. If our AI booms, we could be a $10 billion company fast and 100x. If our AI doesn't, our investment is, hedged by the actual real estate and wedge deals that we buy below market value. That's my take. That's my opinion. I should make that clear. Can I put this somewhere here? There you go. My opinion, not a solicitation or guarantee. Read offering circulars. Right? Yeah. But I always think that's very interesting. Like, I can't help but compare myself to this sort of stuff because, like, when I read this sort of stuff about the AI bubbles or whatever, I always think to myself, okay, like, how can we make sure that, we are not part of the bad, basically? And this is the way I see it. No personal debt, no bank debt at the company, good deals in real estate. Like, I don't want to go to fixer-uppers. And I'd rather just sit around and do nothing. I do it because I do actually kind of enjoy it. But look, just look at the face on my child. This is the face on my child. She looks like Hillary Clinton going into the normie house. It's like, hey, check this out. Isn't this cool? Look at this. And she's like, what the F is this? Moldy underside of the sink. Poor little child. It's like, what the hell, Dad? It's easier not to do that. But, all right. Anyway, okay, cool. So, continuing on here. So, since no one can say whether this is a bubble, I'd advise that no one should go all in without acknowledging the risks they face if things go badly. Yeah, totally agree. This nice AI baby. No, that's actually my child. That is actually my child. Finally, it's essential to bear in mind that there are no magic words in investing. These days, people promoting real estate funds say office buildings are so yesterday, but we're investing in the future through data centers. That scares me, by the way. I think the data center investments are very scary. Like, I love the idea of buying them through bankruptcies. I love the idea of buying data centers through bankruptcies because the glut will come. The glut will come. As a result, they be profitable or not. Intelligent data centers, like everything else, require sober, insightful judgment. I agree. P.S. The following has nothing to do with financial markets or a question about whether AI is subject to the bubble. My topic is the AI impact on society through joblessness. Oh! And purposelessness. Oh, gosh. Okay. This is bad, too. Well, okay. So what do we have here? She was wondering where the coupon code is. Boys and girls, the coupon right now that you could use is Santa Reinvests, okay? Santa Reinvests. So you can go to meetkevin.com, get lifetime access to the Meet Kevin membership. You get all 9 courses, every trade alert, my top 10 stocks to buy, every private live stream, every alpha report. You get the brand new Reinvest course. You get everything. It's already out. The Reinvest course is already out. We released it on schedule on December 9th. Or you can get lifetime access to our AI at reinvest.co or househack.com, whatever you want to type in your domain, doesn't matter. You could read about it on the website, obviously. But the coupon code right now is Santa Reinvest. Poor little girl. It's like, Daddy, what are you doing to me? All right, so let's see what he says now. Oh, Vera. Okay, let's see here. Let's see here. You needn't read anything. It's why it's a prospect, but it's important to me. I've been looking for a place to say a few words about it. Okay. Oh, hold on. I gotta order some eggs. Hey, are you home? Could I bug you for some eggs? I'm starving. The live stream folks, say thank you, Lauren, in advance. She's not here. Okay. She says she can't teleport. I thought you had level 99 magic. What the F? Rip off. What is this? All right. Not yet. Working on it. Oh, you're busy grinding. Got it. All right. My wife is grinding. She can't bring me eggs. Oh. All right. So, Q with a twist. What do you think will happen with Nvidia shares if China attacks Taiwan? Oh, dude. Like, everybody's been asking that for years. I don't think China is so stupid to attack Taiwan. So it'll continue to be, it's been saber rattling for 7 years. It'll be saber rattling for another 7 years. I don't even want to think about the potential of war between China and Taiwan and an invasion or whatever. It'd be such a geopolitical disaster. Yeah. All right. So, I mean, market's relatively stable going into the Fed watches me, Kevin, to become more affordable. Oh, thank you. Market's relatively stable as obviously we wait for Powie Wowie's owie. We'll see if Powie gives us an owie or not. Man, time to DoorDash some Red Robin. Oh, that sounds amazing, but I don't think Red Robin is open. We should DoorDash something together. Wouldn't that be great? DoorDash some food for the Powell meeting so I could just be like a total lazy bum and not get up or do anything. Or like a Carl's Jr. $5 hamburger. Dude, for like $4.70, you could get a double hamburger at Carl's Jr. It is a great deal. Or like, you know, sushi's great. Sushi or steak would be fantastic. Man, sushi looks great. Why am I getting Jack in the Box odds when I look at sushi? Anyway, all right, so let's keep going with this. So, postscript. Okay, on November 18th, a research note from Barclays described Fed Governor Waller as having highlighted how recent stock market enthusiasm around AI is not yet translated to job creation. Correct. Somebody says bullish on Dash. I actually think the Dash valuation is pretty good. We did a course member analysis on Dash, and we were pretty impressed with Dash. I know they've come down recently, but I think did they start recovering? I don't pay attention to them that much. Oh, not that. DoorDash. Yeah. Yeah, it's come down. Oh, it's playing fibs. It's playing fib retracements over here. But actually, yeah, the valuation's pretty good. Dude, Publix Deli, if I had Publix Deli around here, that'd be great. Valuation on Dash. So if I go to the stock tab right now and I put in Dash just to look. So I've got Dash. This is what you see if you go into the Meet Kevin app. You could basically sort by all these various different tickers, whether you want Axon or whatever. Door is at a 2.25 peg. This is only for course members in the Meet Kevin membership. Axon, for example, is at a 3.6 peg, right? Costco is at a 4 peg. AMD is at a 1.3 peg. Circle's at a 1.16 peg. Circle's dirt cheap right now. Best Buy's at a 1.28 peg. These are all based on my fundamental analysis. I don't have an Apple one in here. Adobe's at a 1.46. Like, Circle is cheaper than Adobe right now, which is kind of crazy to think about. But anyway, you could sort by all that in the Meet Kevin membership. It's just sort of a win for course members. Why the hell is Boxable trending? I don't know. They're shilling crypto owners. Is there a Boxable coin? Did they make a shit coin for Boxable? No, they didn't. Oh my God. They've always been a scam. No, they didn't. Oh my gosh. Please, no. Because of Tesla? I mean, this is such old news, though. This, like, Elon bought one of the units or whatever. Did they do something else? What is this? Tesla's innovative partnership for Boxable, game changer for supercharger stations. A collaboration between Tesla and Boxable sparked immense interest. Companies seek to embark on a new venture focusing on modular prefab, potentially a reason. Concept of Tesla supercharger stations. What does this have anything to do with it? Boxable to develop a pilot project for micro amenity structure, compact buildings with small amenity facilities. Oh, to like give like coffee or whatever. Enhancing the entire charging experience. According to Tesla's contractual agreement with Boxable highlights the potential scale of the project, while some details remain on the aim of the building is supercharger locations. Oh, interesting. Okay, micro amenity stuff. Got it. Yeah, it's an interesting idea. The downside is a lot of supercharging stations are already built by amenities. That's the point, is that the landlords want the amenities and they already have the amenities and they collect revenue by doing that, right? So does that potentially hurt existing superchargers who don't want it? So really then you're talking about new supercharger expansion. It's an interesting idea. Let's see here. That's funny. We got a Z stacker douchebag in here. I thought your ETF failed. See, my ETF didn't fail. We returned over 25% for investors. We made really good investments, in my opinion. I thought we did great. And we gave everybody all their money back. I just decided if I'm gonna launch an AI product at HouseHack, and I wanna take HouseHack to the moon and take HouseHack public, why do I wanna deal with all of the compliance that comes with running a registered investment fund and being a licensed financial advisor and running that when the product doesn't make money? Like these are cool products, but they don't make money. And the amount of compliance that you have to deal with is insane. And the fact that I got scammed by Title, in my opinion, because they don't know how to read the law, really pissed me off. So I think, the ETF issuer, I have a big bone to pick with them, but who cares, right? So I look at it as like, no, man, you got to get that out of your life so you can focus on where the real gains are to be made. And look at that. If you look, it's like in the time, think about this. HouseHack existed before the ETF. In the time that we closed the ETF to where we stand now with HouseHack, we literally went from no AI app to having an AI app. Like, people who actually pay attention to this channel are like, so you went from a business that doesn't make money, that comes with massive regulation burdens, and where you have a dick boss, Title, who doesn't let you go all in on Tesla, basically, which would have been a great investment for all the investors. Title screwed people on that. They should be sued. But anyway, that's Title. To here we are with HouseHack releasing an AI app, because all that energy can now be focused on our AI app and our real estate. Like, this is fantastic. And so the true people who watch this channel and realize what we do realize, no, this is actually a great thing. This is fantastic. But then, of course, you're always going to have these random douchebags who try to take things out of context. This is really incredible, So Z Stacker 58, what were you born in 1958? Probably not, because you're probably 14. What is Title? It's Tidal. Tidal. Anyway, it doesn't matter. We don't have to talk bad about them. They'll get their own karma. I don't have to dump on them. I guess I already did. But anyway, let's keep going with this. So this strikes me as paradoxical. Somebody writes AI bubble while promoting AI. Well, the thing is, what I think is an AI bubble, the irony of this bubble, the irony of the AI bubble is the AI bubble has to do with data center overbuild. Ironically, our AI doesn't rely heavily on data centers because we analyze properties once and can share that data to subscribers with basically nominal additional compute. Like, we're not compute constrained because we look at a property, we go, here's what we think that property's worth net worth wise. And we could create output without more data center spend. That's the crazy thing, right? So like, you give me 10 properties, it's like we can analyze that, and then we can analyze that once. It doesn't cost us extra to tell one person or 5 people, right? That's the crazy thing. So it's actually really the opposite. It's almost like hedged from data center risk. It's very interesting. So somebody says watching Kevin roast bots is funny. There are a lot of bots because there are a lot of people can pay for inexpensive hate comments, but we actually don't have too many here. I think we usually don't get bot attacked too much because we have a lot of moderators. A lot of you blue wrench people are really good. Thank you for that. So somebody says, how are ETFs not profitable? The fees? Well, because it costs about $500,000 a year to run an ETF, which would mean your break even's probably somewhere around 50 million bucks, maybe even like 70 million bucks of assets under management. So it's very expensive to run an ETF because of the compliance that's involved. It's extremely expensive. Financial compliance is very exhausting. I'll put it that way. It takes time and it takes money. I view, actually, AI will probably help a lot in the financing sector. It's one of the reasons I actually love AI for finance and banking, for compliance. Hence why I think UiPath has real potential. Like, UiPath has real potential because my POV is healthcare compliance, healthcare, insurance, and finance compliance. Think about that. Healthcare, insurance, and financial compliance. AI, fantastic in this sector. Very interesting. All right, so what is this here? For most jobs, likely 4 to 5 AI's impact will result in a mixture of innovation and automation. It could save about 43% of the time people currently spend working on their tasks. Oh, I'm out of coffee. I hate drinking coffee or going for my coffee and it's empty. Although, look at this mug. Y'all seen this mug? Look how beautiful this is. This is probably one of the favorite mugs that I've had or bought. Next to my Timmy's mug, which is also almost out. But anyway, where were we? So, I find the resulting outlook for employment terrifying. Yes, I agree. I'm enormously... Do you think UiPath is going to stop spending so much money on marketing? Maybe they can't. Well, if you actually look at their last financials, what you'll find is that their marketing spend, if I remember correctly, their marketing spend went down and their revenue went up. That is an example of...
Big PP.
Just saying. All right, cool. I hope that... Somebody says looks like artwork. Well, it's created by an artist. These are one of a kind, actually, these mugs. It's like he charges like $100 for these, but they're so good. So like, I know it's insane for a coffee mug, but it is art. I hope that it holds true for the case of AI. Of course, I'm not much of a futuristic or optimist. That's why it's a good thing I shifted from equities to bonds in 78. Optimists say new jobs will always materialize. I hope that's true, but other optimists say that the artificial intelligence on productivity will cause a huge acceleration in GDP growth. I have quibbles. Okay. All right, we got somebody spamming silver. Thank you for getting to him, D. Brown. Okay. The change in GDP can be thought of hours worked as change in output, productivity. The role of AI in increasing productivity means it will take fewer hours and therefore fewer people. This is true. This is true. Why do you not like them, Bound Music? Let's see here. I find it hard to imagine a world in which AI works shoulder to shoulder with all the people who are employed today. How can employment not decline? I mean, this is kind of true. AI is likely to replace a large number of entry-level workers. Yeah, I totally agree. Like, the amount of work we could do today, in part with AI, compared to when we had a lot more people working with, is incredible. People who process paper without applying a judgment, and junior lawyers who scour the law book for precedents. Maybe even junior investment analysts who create spreadsheets and compile presentation materials. It said that AI could read an MRI better than the average doctor. Wow, that's crazy. Driving is one of the most populous professions in America. A driverless vehicle society is already arriving. Well, that's one of the reasons Tesla has its valuation that it does. You know, Tesla and Google, and to some extent Uber, or potentially the AI plays for auto driving, self-driving. Well, because remember, Uber realizes that we'll end up going driverless. And the thing that's so great about Uber, I don't own any Uber. I'd love for them to crash because I kind of like to buy some of the stock. But one of the great things about Uber is this potential that, like, people go to the app to get a ride. And so they're a great aggregator for people who demand rides. You know, Uber is a great demand aggregator for rides. If they get robo-taxis that they buy from Tesla or whomever, very smart pivot. You know, you don't really need the drivers if the robots are driving it. The margins would skyrocket at Uber. Because you're taking way more of the profit, which also means cost per ride will go down, right? But anyway, imagine the government's response will be called something like universal basic income. The government will simply mail checks to millions of people where there are no jobs. Right. You will own nothing and be happy. Where will the money come from those checks? The job losses I foresee imply reduced tax receipts. Right. That's true. And increased spending on entitlements. Basically debt. Deficits. Greater deficits. Yeah, absolutely. In this new world, will governments be able to fund ever-increasing debts? No. But the Ponzi will keep going for a while. The Ponzi will keep going until banks eventually go bankrupt, right? People will get a lot more from their jobs than just a paycheck. A job gives them a reason to get up in the morning, imparts structure to give to their day, gives them a productive role, right? A job does. Like, I've noticed myself, it gives you self-respect as well. I've noticed I'm most miserable on the days I sleep in and don't work. Like, I feel unproductive, unsuccessful, unhappy. Like, I will say, ironically, I also hate waking up at, 5:30 in the morning or earlier, like 4:45 to 5, depends on what the data is, like the ADP days where they release the damn monthly ADP reports at 5:15. I'm like, you assholes. Okay. Substance checks. I worry about a correlation between the loss of jobs in manufacturing in recent decades, incidents of opioid addiction. Yeah, shortening lifespans. Sure. Yeah, people get into drugs. Yeah, totally. Sonny says, Path is up 30% since you mentioned it, Kevin. Oops. Right, if you eliminate the lower end, eventually you lose the upper end. Eliminating the lower end does risk removing the skilled upper end of the future. That's true. What jobs won't be eliminated? Think about the jobs machines can't perform. Plumbers, electricians, masseuses, physical tasks, well, for now. Nurses can deliver hands-on care. Artists, athletes, And what distinguishes the best artists and athletes in that? I think something called talent or insight, which AI might not be able to replicate. Right. Finally, I'm concerned that a small number of highly educated billionaires living on the coast will be viewed as having created technology that puts millions out of work. This promises even more social and political division that we have now. Yeah, definitely. It's insane. You and I have lived from the rotary phone and analog TV days to AI and computer glasses. Computer glass. Oh, yeah, that we wear, like the camera glasses and stuff. Yeah, that's true. It is wild. I get no pleasure from this. Will Optimus explain while I'm wrong? Interestingly, Vanguard's Joe Davis points out that more Americans are turning 25 than in any preceding year. Wow. This was great, by the way. I mean, this was a long piece. It's taken like 2 hours, I feel like, to go through this. But this was a fantastic piece. We'll do a summary on it later. I don't want to summarize all of it right now. I'm exhausted. I want DoorDash is what I want. But I wonder if Lauren's back. You back? Okay. Cool. All right. Can you please talk about why it's important for people to trust the Fed? Well, yeah, you have to believe in the Ponzi, right? So you have to, like, trust in the Fed is all about believing in the Ponzi, because it is a Ponzi. It is a scam. But you kind of have to be part of it, sadly. But how do you hedge yourself? That's why we have to, we trust the Fed, because it's the only thing that holds the Ponzi of government spending up. Eventually, that'll collapse. And that, that's why I'm relatively simplistic in saying I like owning real estate in places people want to live. That sounds like really overly simplistic, but if you've ever been in Southern California, or like the Southern California coastline, or in the chaparral climate on the edges of the Mediterranean or Australia, you know why people want to live there. I don't care if you're on UBI or you have a job or whatever, you want to be there. And yeah, that is interesting, because like ultimately that's what it'll come down to. If you get a UBI check, where would you rather live? Right? In hell? Anyway. So great. Now we've got the Fed. You can see the market's pretty much flat on the day here. MP material keeps bleeding. I suspect it will probably keep going down to $31, unfortunately, for MP. But that's okay. We've been talking about that for a while. We also saw GameStop tried recovering a little bit. 5% decline, heavily because of Bitcoin losses. Who was here when we talked about our Bitcoin spreadsheet? I mean, we literally made a whole spreadsheet on this. And let's see here. Bill, where was our Bitcoin tracker? We did this. Bitcoin losses to gap income numbers. Remember that? So we did a whole sheet on this. Well, sorry, I closed it. There it is, right? We did this, and literally one of the companies we put in here, unfortunately, was GameStop. And we flagged that these Bitcoin losses, I mean, we're a little higher than 85K now, which is good. But we flagged that was going to end up being a problem because these companies were going to recognize this. So I'm kind of surprised the market is surprised, because it just seems so obvious. But then again, people don't always pay attention to what's obvious. All right, what else do we have? So, next, All right. Inside Meta's pivot from open source to money-making AI model. Buying calls on GME. I actually think the fundamentals of GME, I mean, I got to look at the actual earnings, but the fundamentals of GME were actually pretty good the last time we looked at it. Because they had, the last time we looked at it, they had increasing revenues. The balance sheet is very strong at them, at GameStop. We've got, they did release their 10Q. So if you just look at their inline docs really quick, their balance sheet, I've got almost $8 billion in cash, marketables. I've got $9 billion here on the balance sheet, which is really good. And then if I look at current liabilities, they have less than $1 billion, long-term debt $4 billion. So I've got a crap load of free cash. And if I look at gross profit, it actually, their sales did decline year over year. So I did have a year-over-year decline in sales, but cost of sales up. I'll have to divide that or compare that to their last quarter. How does that compare to the last quarter? Because if I go to, and then the Fed, we got about an hour and a half to go until the Fed. GME, 10Q, here it is, 11/25/21. So this is when I last looked at GameStop, was 11/21. We set up the expectations here. This was their, oh man. Yeah, their net sales really declined from the last quarter. Because look at that. That's a big decline from the last quarter. Let's download this so I could save it. Save. 10Q, 12/10, save. Okay. So if I go here, I end up seeing net sales in the quarter that are down from 972. Ouch. 821 divided by 972. Minus 15.5% from last quarter. And then we're down 821 divided by 860, minus 4.5% from last year. Yeah, I know they're trying to close the money-losing stores. Unrealized income, loss. I've got asset impairments. What do we got here? Selling SG&As. Nice SG&A cut, though. Nice SG&A cut. How does that compare to last quarter? SG&A 218. Yeah, it's slightly up from last year, though those cuts seem done as now up about 1.5% from last quarter. So, all right. Cool. What else? Let's go back. What is this Meta talk? Meta. So Meta, months into building, one of the priciest technologies, is personally getting involved in day-to-day. Good, get back to work, homie. New codename Avocado is expected to debut in spring. Man, I think these are all going to be a commodity, though. That's a problem. The move, which aligns with what rivals Google and OpenAI to do with their models, would mark the biggest departure to date from the open source strategy. Open source models allow outside developers and researchers to review and build upon the code. Meta's new chief is an advocate of closed models. Yeah, so they could try to make dollars off of it. So the AI, Llama right now is pretty trash. Okay. The AI boom is absorbing everything. Musk would almost be an instant trillionaire from the AI SpaceX. Oh, yeah, dude. World's first trillionaire coming up. 90 minutes to JPOW, hell yeah. AI boom is absorbing everything. What do we got here? AI data center companies are buying up the assets of Bitcoin mining companies. Pretty straightforward idea. Bitcoin mining is a pretty mediocre business. Just look at the share prices of any of the public mining companies. very valuable to anyone building. The electricity grid is valuable to anybody building a data center. And it's really going from like one fad to another. Company is trying to build supersonic, successfully launching VC-backed aerospace company. Anyway, Blake announced this morning that his company is doing a slight pivot. It's not a whole pivot. The pathway to the jet is still alive, but they will now be selling a 42 megawatt natural gas turbine optimized for data centers. Wow, that's smart. They basically took the jets and put them in a box. That's hilarious, dude. That's brilliant. Wow. The deal also gives Boom cash. What deal? That's really smart. A new product, a new customer, and new financing. Introducing Superpower, a 42 megawatt natural gas turbine optimized for AI data centers built on supersonic technology. Superpower launches with 1.2 gigawatt order from these people. Backstory, thread. 3 years ago, we started working on our Symphony supersonic engine. But we watched an energy crisis develop. Like all our great ideas, this started with reading X. Shill Elon. Shill Elon. He needs the investment from Elon. He needs Elon to prop him up. This is a great way to get that. As I was pushing to legalize supersonic, I kept hearing about AI companies couldn't get enough electricity. Large arrays of mid-sized turbines are the blade servers of the energy world. Existing aeroderivative turbines were old technology based on 1970s jet engines. This means they didn't perform well in the real world. Okay. I texted Sam Altman, who's been a Boom investor for more than a decade. Would a 42 megawatt natural gas turbine be helpful? The answer was a resounding yes. 90 days, I mean, they basically put the engine in a box. I mean, that's kind of brilliant. Hey, let's put this shit in a box and sell it to AI data centers. That's amazing. Turbines took the heat even worse than humans. The only way to avoid a meltdown was to throttle back. Right. Our engine was designed to run at Mach 1.7, where temperatures are 160 degrees. This means under real-world conditions, 4 of our supersonic turbines could do the job of 7 legacy units without the cooling water required. That's great. That's pretty big. That's great. 300 million financing to fully fund the superpower turbines. Wow. First superpower turbine. And we're building our new super factory in Denver. More to come next year. Time to build supersonic. That's very impressive. I like that a lot. I think that's a fantastic idea. Great. Turbine from Boom would ease those constraints, building out the technology. Blah, 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 blah. Yeah. Very cool. All right. What about this? Musk instant trillionaire. The richest man in the world could more than double his fortune if SpaceX goes public next year. Yeah. Yeah. Cool. All right. That's good. That's good. That's good. All looks good. City Citi Self-Invest account. A self-trading platform with Citi Wealth Management. Everybody's trying to get into it because Robinhood's been kicking butt. Huh? Makes a lot of sense. All right, cool. All looks good. All right, now, Elon Musk's stake in the space company alone could be worth more than $625 billion. Wow. So that implies he has a 625 divided by 1,500. He's got a 41% stake. 41% is what that implies. Wow. Wow. That's a lot. Doesn't include his multi-billion-dollar stake in the number of other enterprises, including Tesla. Right. Total fortune would be $952 billion. This opens up his second clear path to become the world's first trillionaire after securing a 12-figure pay package deal at Tesla. Right. Musk owns roughly 42% of Starbase, Texas-based SpaceX. Starbase Texas-based SpaceX. 42%. Aha. Wow. That's wild. Ambitious goal. Okay. Well, very interesting. I guess he's going to beat Sam Altman after all. All right, good. Amex CEO says Thanksgiving holiday consumer spending climbed 9%. Wow. Stock stuck in wait-and-see mode. Yeah, well, that's true. DeepSeek still using the NVIDIA chips? Okay. Let's see here. Saw that. China's DeepSeek. NVIDIA's Blackwell chips were smuggled into China through countries that permitted their sale. Well, that's not a surprise. I mean, we like Singapore or whatever. Malaysia through the way of a fake real estate business. Nice. Yeah, classic. It doesn't surprise me at all. I think the rumor is that it could be as much as, I don't know what percentage. Never mind. I can't remember. But there's a chunk of NVIDIA spending that's just going to AI or China anyway. But now they're basically just legalizing and taxing it. So it's like we all already knew that. Consumer spending around Thanksgiving rose 9% at Amex. Yeah, but Amex appeals to your premium card spending growth. Your more, higher income user. Yeah, catering to affluent customers. Yeah, it doesn't surprise me that Amex is reporting a greater increased spend than other companies. Investors bet the bid for Warner is coming. Okay, debt fuel deal. Massive debt fuel deals are back. Oh yeah, there was a big First Brands article yesterday. What was that? Bloomberg First Brands. This was crazy. So this is major investors in First Brands have offloaded stakes in the bankrupt auto supplier's debt in recent days, causing the value of its most senior loan to collapse and prompting it to pull forward a lender call to calm nerves. Marathon Asset Management and Redwood Capital Management are among the funds that have sold chunks of the super senior loan they provided as it crashed into a Chapter 11 restructuring. Okay, sold chunks. Yeah, get rid of the risk, basically. Okay. Sell portions of their debt stakes, but it's unclear if they were successful. It's rare for investors to head for the exits as so soon after a bankruptcy filing. Some recent trades suggest concern about the ability to turn it around after allegations of fraud. Yeah. Scary. Those concerns were reinforced during a call late Tuesday when advisors to creditors spoke bluntly about the company's need for fresh funding. This is how the bubbles pop. Price levels from trading desks reflect investor fears. Okay. It's other debt. Yeah. You don't say. Let's see here. Marathon sold its entire stake in the new money portion of the bankruptcy loan at or above 105 cents on the dollar. Oh, so they got out with dollar holders. Redwood sales of the new money portion of the loan. First brands declined to comment. Important milestone. Let's see. Part of the pessimism stems from the fact that fees are piling up. Well, yeah. Advisor fees. Oh, people make so much money off these bankruptcy cases. It's crazy. All right, well, that's not great. Okay. So, what else? We talked to Amex. We saw this. Massive debt. Oh, no. Okay, yeah, here we go. Big ticket mergers, Warner Brothers, right? It's a debt deal. Yeah, debt-heavy deals, large paydays, more risks for bond investors. I agree. Showing signs of overexuberance. I mean, that's kind of like what Howard Marks was talking about. What is this big thing? Oh, it's a giant ad. That's crazy. Warner Brothers bonds due. Okay, whatever. Next. Everyday investors hedging against an AI bubble. Oh, are people buying CDSs? Brian Hahn had most of his savings in tech stocks for a decade. As an escalating artificial intelligence frenzy this year set the market to new highs, he sold it all. 51-year-old teacher had 80% of his investments in tech. Wow. In October, he put most of that money into gold. It was too much risk for me to assume it was going to keep moving higher. Well, I feel like gold has bubbled up a little bit, eh? It feels like moving during the fear of October sale to the next momentum move of gold. But all right. Blah, blah, blah. It's not just the pros who are worried. Average investor is likely exposed to AI. Well, duh. Probably all are. Everyday investors, record volumes. Exceeding the 2021 meme stock craze. That was fun. 31 invested in NVIDIA holdings, blah, blah, blah. Cool. All right. What are the comments on it? Article, a 7th sentence from 4 retail investors with exactly no data or research. Yeah, it's kind of what it feels like. Okay. Rate projections in focus. Well, yeah, we got to get the summary of economic projections. Tough time for home flippers. This is why it's a terrible business to be in. And Open Door is just in a horrible spot. Home flipping is down 7% in 2024. Hate flipping. The economics of house flipping, the tantalizing, get-rich-quick strategy that lures so many into real estate. Yep. Sunk $135,000 into a house. Blah, blah, blah. Rate cuts, heightened problems, no simple fix. For flipping. Well, the debt is very expensive to get your hands on it. Gambling on good bones. Oh, that's a juicy one. That's a good looking one right here. Yeah, we're closing on one today, actually, that looks like absolute trash. Do I have it? Yeah, well, I guess I have the Matterport of it. I'll show you one just for giggles while we, wait for the Fed business here. I'll show you one of our recents, and then we'll get back to like market stuff. Okay, so this is, we'll go to edit, before save. Okay. There we go. Look at this sexy beast. This is literally what we're closing on today. See, like, this is why I say we're real estate backed. We buy this crap and we fix it up, and our balance sheet basically benefits because something like this, we'll put a good chunk of money in and we'll clean up all the mold. I mean, look how nasty this stuff is. But I always think it's funny because people are like, oh, but Kevin, you're taking homes away by buying the homes. Really? Really? You think a home buyer wants to buy this? You think a tenant wants to live in this? This is freaking disgusting. You need somebody like me who has the balls to clean this crap up and make it a livable property. And look at this. This is disgusting. It takes people like us to actually provide value to people and make this a livable house. So, this is what we do. We take this kind of garbage and we turn them into, good quality homes that people can live in. I'll show you. Oh, we don't have an after yet. Darn, I want to show. Wait, we have pictures though. I'll show you. It's not as good though. Dang it. Really got to get the after. But, just a quick example of the after. I'll just grab some of the professional photos of just what we try to turn it into afterwards. And they're gorgeous because, it's basic, but like this is our job. You take a property that's trashed like that and you turn it into something like this, Like this is actually like a livable property and functional. So imagine like that kitchen that you saw, that nasty thing turning into this. That's what house hack is. That's when people are investing in house hack. That's what they get. They get us finding the deals in part with our artificial intelligence software, renovating the deals, and increasing the value of the company. It's kind of cool. But anyway, it's not easy. So what else do we have? Let's see here. What are they yapping about over here? Layouts, whole contractors, blah, blah, blah. They secure, assignment contracts. Yeah. You see this a lot too. People try to wholesale deals. Worst case scenario, cannot get the price we need to break even or make a profit. We will hold the property and lease it for rental income. Yeah, that works as long as you don't have big debt, these flippers. Somebody says, how can somebody live like this, Kevin? Typically what happens is, unfortunately, people are mentally ill or they're elderly, right? So like they don't actually see this. So what you have to remember is that the property is covered in stuff. So they don't see all this garbage. Like it's so filled to the walls with trash that they don't even know their property is full of rat feces and mold and all this nasty stuff. That's what makes it actually very dangerous. Like I'll show you the garage. This is the garage. This is what it looks like, So look at this. They have a box of Halloween costumes. Like, why are you keeping all this crap? But people do. And this is just the nature of unfortunately, hoarding, basically. And so imagine the entire interior of the property just covered. and you make little pathways to get around, right? You know, all these old paintings or junk or whatever, files, old papers. Like, who needs all this crap? You know, what even is this? An old metal rack or something? Shelf or something? I don't know. I don't know. It's just gross. So, but that's just an example. Yeah, what we should do is we should go do like a giveaway, and you guys just show up and go to the garage and take what you want. But honestly, there's usually not that much valuable stuff. All right, next. Anyway, that's what we do at HouseHack. If you want to invest, you go to househack.com/reinvest.co. It's the same company. This is not a solicitation. Read the offering circular. You can invest in our August of 2024 valuation before we had an AI app that we were selling. And we're backed by that kind of real estate that we fix up. And we make money on it. Yes, that's the goal. All right, hashtag no guarantees. All right, Fed meeting coming up soon. What else do we have? What is this? Challenges, European security. Fed expected to cut again. Race to replace Powell. Yes. Judge rules National Guard deployment in LA must end. Uh-huh. Okay. Oh, yeah, you're right. Let me fix that link. Oh, that is interesting. I totally forgot that I had a pinned comment. I'll fix that. Just go to reinvest.co or househack.com. But I will fix that. Epstein Transparency Act. Okay, let's go look at what the New York Times is saying about the Fed. Remember Smilyak, Blondie, who doesn't work at the, it doesn't go to the, oh wait, hold on. What are they saying?
Thank you very much, Scott, and welcome to The Exchange. I'm Kelly Evans, and we're less than an hour away from a rate cut decision. Will it be one and done or more to come? Our guests have some very different opinions about that. With us this hour, FundStrat's Tom Lee, who says it's one and done, but it won't derail the rally. Ironside's Barry Knapp is much more dovish, but with a major caveat.
There we go. I'll fix the pinned message. Thanks for letting me know.
The Fed should cut at all today. VC Low Tony says a cut is needed, but it could also add fuel to the AI debt boom. And we'll hear in a CNBC exclusive from Blackstone's Jonathan Gray. Plus, the creator of the Sahm rule, economist Claudia Sahm, says we do need an insurance cut today. She'll be here to explain why. With stocks in a holding pattern until this decision, you can see literally almost unchanged. 10-year looking a little better, too, at 416. Let's get straight to Washington and Steve Leisman.
What's the ticker for your... Our company's not public. It's a private investment. Househack.com.
Rates for a third straight time, but signal a higher bar for future cuts. And while the Fed meets, the president expected to hold interviews to narrow down his choice to replace Fed Chair Jay Powell next year. Futures market fully pricing in at 90% for a cut today, but that falls off sharply in January. You can see there, and there isn't really another cut confidently priced in until June. What happens then? Well, Powell's successor will take office.
We made a plan, by the way, for this in the Alpha Report. So if you're a course member and you haven't yet looked at the plan, make sure you watch the plan or look at the plan in the Alpha Report. And if you're not a member yet, you can still join. Just go to meetkevin.com and use the coupon code Santa Reinvest.
Pause rate cuts. Further signal could come in the Fed's forecast and the dot plot, maybe some dissents, with disagreement seen continuing on the committee over how many rate cuts will be forecast for next year. CNBC able to report that the president will hold a series of interviews with prospective Fed candidates or Fed chair nominees, beginning with former Fed Governor Kevin Warsh today. We can also confirm an interview with betting market favorite Kevin Hassett and Fed Governor Chris Waller further down in the probabilities. All of this taking place in a very curious environment, Kelly, of rising bond market yields, unusual for a time when the Fed is cutting, and the Fed making policy forecasts in the absence of official data that come out next week. So the outlook could change sharply, not just with the statement and with the Powell press conference, but in 7 days when we get all that data, Kelly.
That's exactly right. I know you've said they should wait. Did anyone ever entertain that concept there, Steve, that you floated to them?
Maybe for a nanosecond, but I think they decided that they would not look good if they were waiting on one piece of data, to which my argument was it's not one piece of data. It's 2 months of jobs data, and it's a bunch of inflation data. So we'll see. Maybe it's the right call. I do think, Kelly, it's worth pointing out, their thinking, I believe, is on a risk management basis, that whatever happens next week, they'll feel better if they had cut in the face of a weakening job market, then they would have not cutting if inflation is a bit elevated.
Yeah, exactly. It's hard to do it and then get so much more information about the economy. I understand that. Steve, for now, thanks. We'll let you go, and we'll see you soon for the big decision. Steve Leisman down at the Fed. And let's bring in our first panel now, which is Barry Knapp, the Director of Research at Ironsides Macro, and Tom Lee, Fundstrat Global Advisors Managing Partner. Welcome to you both. Tom, you're more, I don't want to make it sound like you have a point of view other than you're expecting a more hawkish Fed, and Barry, you're expecting one that's a little bit more dovish. So Tom, you're more in line with consensus right now. What would that look like, and why are you still bullish on stock prices?
Well, I think precisely because our clients are expecting a hawkish cut. So exactly as Steve laid out, Fed does a cut, but future cuts are uncertain, not even maybe until June. Now, because that's the base case, then if that's what happens, of course, markets have already been bracing for that, and they've been bracing for it since October. And of course, there's a chance that it's a dovish cut, which would be bullish as well. And then I think
what to you would be a dovish cut? So, are there projections? Are there dots?
Yes.
There is. So we'll know right away if they come out and those projections show that they're expecting more rate cuts next year. Then you're saying we might only get one more in the summer.
That's right, and it could also be interpreted dovishly if they start acknowledging the balance of risks are shifting, so that then markets can realize the Fed is now acknowledging there's some underlying fragility of the economy. And of course now QE is, because QT is ending, it's essentially not QT, which is QE. And there's, of course, the chance that there's something positive the Fed has to say. So I think
QT is not QE, dumbass.
The reaction's positive.
And there's so much more you're queuing up here we're going to get into. But on a top level, why isn't it a bigger roadblock for markets, Tom? You could look at this and just say, well, we're already basically at all-time highs. Look at the Russells and so forth. And Powell's been known to not have a very favorable reaction to his commentary, and he's only got a few meetings left, so maybe he's even more hawkish than usual. I don't know. Why don't you think that's a bigger risk? And whether it's, I'm not just myopically even talking about this afternoon, but kind of setting the tone into year end and then into next year.
Yeah. I think part of it is just the market's now adjusted to the idea that the Fed is institutionally slightly hawkish. Now, part of it may be because that there could be undue pressure coming from outside the Fed, and the institution wants to protect its integrity, and that comes across as hawkish. But
all right, I just made myself the eggs, and then the second I finished making myself the eggs, Lauren walks in, and she's like, "Hey, I can make you eggs." Like, the guy's like, "Oh, we ended QT. We ended QT, so that's basically QE." I'm like, "No, it's not. What are you smoking, dude?"
COVID period to react to, where you know that someone like Powell, who's about to leave, is going to want to say, "I didn't reopen the door to inflation." Right?
Yeah, that's right.
For that
Protect his
institutional
legacy.
Exactly. So Barry, all of that said and done, there are still lots of people starting to talk about this quantitative easing issue. So it's a little bit confusing when you have. Are we to view that even as economic policy making, or is that something completely different that just has to do with the plumbing of the financial system?
So for 3 years, you and I have been talking about the Fed eased primarily using their balance sheet, but tightened using only one of three channels that they have, which is they've just been draining reserves from the system. And so that's the plumbing issue, which is getting tight. But the much more important and impactful part of QE is when they're buying treasury notes and mortgage-backed securities. That lowers long-term rates, which is what really influences equity price.
Right. What he's talking about is QE. So, look, here's the thing. Just because we ended QT doesn't mean we go to QE. Now, eventually that can happen if the economy keeps weakening, right? Tom Lee says QT ending is basically QE. Okay, this is false. So just abjectly knowing it, yes, the vacuum cleaner stops, which is bullish. That's fair. But QE ending and short-term funding like Tomo is liquidity. It's shock prevention is what it is, okay? QT is, as this guy said, buying the long end of the curve, treasuries, QE, right? And providing long-term, not overnight, liquidity to markets. So that's the difference, and I think people should understand that. Now, would it make sense that as we go from QT that we're closer to QE? Of course, once you pause QT. But it would take more fundamental weakening in the economy, which maybe we will get that. I was listening to Steve Leisman. Steve Leisman's right. I actually think Steve Leisman had a really good point about waiting for the data. Steve Leisman suggests Fed should have delayed meeting to next week. I agree. Big data on 16th and 18th for jobs and CPI. We haven't had this. We haven't had this data. There will be no jobs data for October. There will be no jobs data for October. So jobs report coming up will be like getting October and November jobs data in one report. So he's kind of right about that. I agree with him. So if we look at the BLS schedule of releases, it's the 16th and the 18th. Let me just see which one's which. Employment situation will be the 16th. Okay. I wonder if we have forecast on it yet. We'll have to go find out. So let's write that down here. So that way we have that sort of documented. Jobs report on 16th for November, which again should factor in some of the October. Well, eat my eggs. Okay, and then so on the 16th, we're expecting 50K. 50K is current market expectation. And then if I look at the 18th, we are looking at a CPI of 3.1 year over year and 3.0 core. Let's go back in over here.
Buy stocks because this is coming, so it's important to know whether it's coming or not.
Comes from the banks, though.
Yeah,
Fair.
But in the crypto world, QT was draining liquidity. So the ending of QT is essentially QE, because if they're just holding the balance sheet flat, they are still going to be essentially adding liquidity to the system.
Just to maintain the size.
It's by not removing it. He's making the argument that not removing liquidity is basically quantitative easing. It's not, but that's a nice thing for him to say for his crypto pump.
Just keep going. Do you have a bullish view still on small caps if we're finally going to get that rate coming down a little bit? Where should people look for alpha or outperformance?
2026 is a year there's a new Fed, right? But a dovish tilt. And at a time when the ISM's been below 50 for a record more than 3 years. So that's really good for small caps. And as Barry says, if they deregulate banking, and we were talking about this offline, that's really good for small caps. But that's also really good for the business cycle. And we've talked about this in some of our past research. Crypto prices are really sensitive to the ISM. So the ISM moving back above 50 has historically been associated with actually super cycle moves in Bitcoin and Ethereum.
Wait, ISM going into expansion territory is positive for Bitcoin?
Correct.
And for all, interesting.
Yeah, and so if you look at ISM and Bitcoin, and you detrend Bitcoin, essentially look at its distance from the 200-day, it's almost perfectly correlated to the ISM.
Surprising.
And same thing with copper to gold prices. So copper's an industrial metal versus gold is a monetary.
Right, but all of that tells you that it's basically just risk on, that they're all behaving like an economy. And am I overcharacterizing it?
I think that's right. I think Bitcoin's a bit of a chameleon because there'll probably be a time when it acts like gold, but right now it acts a lot more like it's sensitive to monetary policy and the business cycle, and both are about to turn up. So that would mean anybody who thinks the Bitcoin 4-year cycle means crypto prices are down next year, we're betting against that, thinking that new highs come early.
That's
like
fascinating.
in January.
As a final word, we're about to talk to Jason Furman, Barry, who says the Fed should not be cutting because of inflation. And I'm just curious what your response would be to that.
That the rate did not trigger the 2021-22 inflation. The Fed cut the policy rate from 1.5 to 0
So it's worth noting what he's basically saying is, as we get back, I mean, aligning ISM inflections to 50 makes logical sense because it means you're going from a period of a slowdown or recessionary period into an expansionary territory or expansionary environment. Of course, risk assets go up in an expansionary territory. So the fact that like ISM's going above 50 aligns with Bitcoin, of course, that has historically happened since 2008. That makes absolute sense. And it's not necessarily indicative, though, that we will have a bullish upcycle in the business cycle. What if we have a down cycle, right? That's the argument to keep in mind.
About steepening
in the AI
yield
space,
curve, right? And steepening the yield curve so that small banks can start lending to small real estate developers and small businesses, and we can stabilize the part of the economy that's really weak.
So again, you think they can lower rates and still lean against the AI bubble?
For sure, because the thing that determines stock prices over time, we create an equity risk premium. We use the 10-year TIPS yield, the real yield from the 10-year part of the curve, not the policy rate, right? So this liquidity versus longer-term rates is a crucial distinction. And I would argue to Jason, if they really want to control inflation, the thing is making this process, privatizing the Fed's balance sheet so that price-sensitive buyers own the debt, and the government can't go wild.
Barry wants long-term rates to go higher. You're never going to get
They're not going. I want to be clear. They're not going far higher because Bessent does have some tools underway. The deregulation of the banking sector. He could eliminate the 20-year. There's other things he's going to do.
Yeah.
But I do think a 440 to 450 move or so in 10s early in the year and a much steeper yield curve is probable.
And that would be the right formula.
But that's also bad, a much steeper yield curve, because then we're bouncing off our 50 or 60, which is shock risk.
The balance sheet is just so crucial, and it was so crucial to what happened in 21.
Yeah.
And it's so crucial to the outlook going forward. The Fed owns $6.25 trillion of securities. The committee at the last meeting in the minutes said they think that portfolio should have this roughly the same duration as Treasuries outstanding.
Yeah.
That would imply they should own $2 trillion of bills, not $200 billion.
We don't even need stable coins. We see we're solving all these problems at once. Gentlemen, thanks. Really appreciate it. And of course, we'll find out in 45 minutes what they decide, Barry Knapp and Tom Lee. Thanks for coming on set today. Former CEA Chair Jason Furman does say the Fed shouldn't cut today. He'll make his case and tell us what he wants in the next Fed chair right after this quick break. Plus, Blackstone President and COO Jonathan Gray will be here. The firm has over $1 trillion in AUM and huge exposure.
Well, we're good eggs. I mean, I hate to say it, but like the problem with Tom Lee is that it's always going to be a bullish tilt. So remember what he says. Bitcoin is almost perfectly aligned with the ISM inflections, bullish when breaking above 50. The business cycle is about to go up. That's what he says. He says the business cycle is about to go up. New highs coming early January. Those were his words. We're quoting him. Okay? I mean, no crap. Like, that's why I wrote no SH19. Basically saying when the economy goes from slowdown to expansion, we see risk assets go up. Duh. No duh. The problem is the risk being blind to downside risk over leveraging, and then you go BK if the business cycle doesn't go up, right? That's the concern, obviously. And so I think hedging against that and being a little bit reasonable is probably a safe thing to do, but whatever. So what do we got over here? Uber's down 6% today. Look at that. What's the news on Uber anyway? So Waymo reaches 14 million rides in 2024 or 2025. Stock investors are cautious ahead of the Fed, blah, blah, blah. Yeah, we got to set up bingo here soon too. So we're going to set up some Fed bingo. What am I snacking on? I just had my eggs. I put 6 eggs in my mouth. I got to get me more dietary cholesterol. All right. So let's do... How about we set up Fed bingo so we can get ahead of that. And we will... Let's see here. That's going to be under favorites. Fed bingo! Fed bingo, 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 bingo. Where's my bingo sheet? Where's my bingo sheet? I need my bingo sheet. somewhere around here. Ah, there it is. Bingo. And send it. So let's go ahead and get ready for Fed Bingo. Okay, here we go. So we are now 40-ish minutes away. Open up. Okay. All right, here we go. So let's go with, first of all, he shows up, so he's on time. All right. We're actually going to have a clean bingo board this time. There we go. Powell's on time. And we'll do another freebie here. Let's do purple tie. Purple tie. All right. Balance of risks. We know that's coming. We know that data dependence. Data dependent. This should be like heavily emphasized. I think we'll get another fog analogy. The sort of lighthouse analogy. Expect fog analogy, driving in the fog, and big data, like some of that, like I wouldn't be surprised if he says some of the fog will clear next week, right? So it's basically a way of like punting to next week. You know, then I expect he's going to talk about no evidence of wage inflation, of a concerning level of wage inflation. This is an ECI reference to this morning. Okay. Let's see here. So these are pretty obvious so far. The fog analogy, you expect that. Really, like in terms of cutting for January, I would say January will be based on an assessment of 4 data releases in the next 5 weeks. I mean, think about like the amount of pressure. There we go. The amount of pressure on the data. Assessment of data of the next 4 weeks. The amount of information we're going to get in the next 5 weeks is crazy, right? So some kind of talk about break evens. I'll make a bullish column. So I'll call this right here. We'll call this, let's go with, put some text over here and we'll call this the bullish column. Bullish column. So bullish column will be right here, and there'll be no evidence of the wage issues. Inflation outside of tariffs coming down as expected. That would be bullish. We'll have, we will see, we will see one-time, overtime price increases due in part. Okay, due in part, what's going on? There we go. Due to tariffs. There we go. Okay, but that's okay, as long as we're not seeing it everywhere. No evidence tariff inflation has spread would be good. No evidence tariff inflation has spread or become self-fulfilling. Inflation expectations are anchored. This should be an easy bingo on the left side. You know, and it's bullish, okay? So that's bullish the economy. So I'll say bullish economy. But bearish many cuts, right? So kind of worth clarifying that, I think. And then, you know, this would be the more dovish stuff. More dovish stuff would be stuff like, you know, if labor force participation rises meaningfully, we could see unemployment rate significantly higher. I'll say significantly higher. And, unclear how AI will affect the labor market. Unclear if AI will aid the labor market, job creation, right? Before we face an uptick in layoffs and joblessness, right? So what they might also say is something to the effect of, businesses that are hiring are struggling finding the right talent, right? There's some shortage of the right talent. We are seeing that issue. Something about break-evens around 0. Labor break-evens around 0 to 20K. That is roughly what we're seeing right now, right? We're seeing, the data suggests we're here. Data suggests we're at break-evens. So that would sort of be a bonus if he says that. Okay. It'd be crazy if they announced Tomo. But let's see, Hassett's yapping right now as well. Hassett, you could definitely get 50 or even more. Fox News. Hold on. Is he on Fox Business or Fox News?
Improved productivity. I remember Alan Greenspan, brilliant guy, in the 90s.
That we've saved a couple $1,000s of that $14,000 already. So we're making great progress. We made huge progress in the last term, and right now all of the indicators are that the 3% growth that we gave you last time is a really, really low ball estimate of what we're going to be able to deliver, because we've got the AI boom making productivity go through the roof. We've got 18 trillion in new factories being built. We're actually tracking the groundbreakings. We're up to about 30 of them since September, and so the economy is booming. Jobs are growing. But people were absolutely harmed, and so again, and the president went through every single price of everything in the charts, and he did a lot of it last night. The bottom line is that if you were just a typical family, your month's groceries cost $400 when President Trump left office, and it cost almost $550 when Joe Biden left office. So that extra $150 a month, after paying also $14,000 more a year for your mortgage, it really adds up to a lot of stuff that has to be fixed. Final thing on this is that real wages are growing again.
That's right.
And so purchasing power is up. It was down about $3,000 on average, not counting the House part, for Biden, and it's already up about $1,200.
I've quoted you many times on that, because that is the case. And as prices could stay where they are, I mean, they could even go up some, but as long as the wages and earnings are going up even more, purchasing power and affordability goes up for the American people. Final question to you. I am told that the markets, we're watching the stock market soaring still to record high after record high, up another 200 points the Dow today, has priced in Kevin Hassett as the next Federal Reserve Chair. Is that going to happen?
Look, the president is going to make the final choice in the next week or two. We've got a number of excellent candidates. We've got Chris Waller, who's one of the world's leading monetary theorists. We've got Kevin Warsh, who was a Fed governor back during the financial crisis, has lots of real-world experience. There are a lot of people that the president is thinking about to make.
It's very generous, but who wants the job the most?
I'm honored to be on the list with guys like that. And the thing is that the president doesn't have a hard choice. He's got nothing but good choices, and that's the way to think about it.
Got it. Always a gentleman. Kevin Hassett joining us here on America Reports. Appreciate it.
Now, that's actually really interesting if they pick within the next week or two, because if you end up getting any kind of sell down from the Fed, you could end up getting some enthusiasm from the Hassett pick to choose Fed chair within the next week or two, says Hassett. All right, interesting. Okay, so then we've got that plane crash was crazy, by the way. I guess everybody survived that one. I thought it was wild because I actually responded to it on X yesterday when I saw it. What I thought was wild about it is after that crash happens, which is just insane, but look in the background. Look what spawns in, like, right here. Wait for it. 3, 2, 1-ish. There it is. Wait, there it is. Cop. And so naturally, I'm like, the cop spawning in was insane. It's like, oh, there's a cop right there. Just appears. It's weird how that works. Anyway, okay, so finishing our Fed bingo here. We've got the cues. Here's that Fed nervousness right before the Fed. This is totally normal, totally expected, especially since we're going through an SEP. We're getting a dot plot. Remember, we also have the last dot plot up. Open. There it is. Here's the last dot plot, and here are my expectations. Green is now, green was then, red is right now. And so I think they're going to write up GDP and unemployment and inflation. I think these will all go up, but we'll see, because what these come out with will determine whether this is hawkish or dovish or what. Thank you for those of you who just joined. I just took a look. Thank you for those of you who just joined either the Meet Kevin membership or the Reinvest AI. You can see our game plan for the Fed meeting. And then those of you who are joining the Reinvest AI, stay tuned for that product coming out this month. James just joined. Francis, Cristiano, Elber, Andrew, BW, Paul. Paul got doubled up. Paul got both. Paul got the Meet Kevin membership and then joined Reinvest AI. Welcome aboard, Paul. Eduardo, Carlos, Jesus, Alfonso, Wilbur, Dennis, welcome aboard. Thank you all for joining. Very cool. Okay, so let's focus on finishing this bingo board. And that's at meetkevin.com or reinvest.co. So looking at the bingo board, we've got labor break-evens. We expect to be around 0 to 20. Data suggests we're break-even. No evidence of a concerning level of wage inflation. We know that. Businesses are struggling hiring. We know that. Balance of risk, data dependent. We could talk about, we could throw an easy one over here. We could do the dual mandate, classic. We'll put that over here. You could talk about some maybe foreign deflation, right? Chinese manufacturing aiding in deflation, right? That's actually somewhat, I wouldn't call it dovish. Well, I guess you could call it dovish because you could reduce rates, more with that. Unfortunately, obviously, tariffs take some of that deflation away. So worth noting, tariffs reduce some of that deflation we would otherwise experience, right? Okay, so then we've got on time. We've only got a few more slots. What other things should we throw? We've got about 30 minutes to go until the Fed here. We'll get the cut. I'll say we get hawkish cut. And that's the base case scenario with no commitment. I'll say no commitment on January. And how many rate cuts do we think they'll forecast? I think this is supposed to say 2 in 2026. I think they'll stick with that forecast of 2 in 26. So I'm going to say that the end of 26, this will probably drop down to 3.1 for the end of 26. Maybe 3. No, I'll leave it 3.1. I'll stick with my gut. So I will put 3.1 right there. Okay. Labor softening. Yeah, but are we? I feel like he's more likely to reiterate that labor has softened, but it's somewhat stable right now, right? This is what we predicted last time as well. Labor has softened, but stable. I think that's pretty critical right now. Yeah, jobs are stable. That's the line. Something to the effect of jobs are stable. Should that change, should any instability come, we're prepared to act. And that could be in funding or jobs, right? Because you could see that in funding markets or jobs. Funding markets would be Tomo or jobs. Okay, come on. Stop pre-filling in tomorrow. There we go. All right, perfect. All right. So no comments on next chair. No comments on next chair. And I got a few more here. What do we have also for the current rate cut expectations? I think we're at still 96% we're going to get here. You know what would be really bad is if you hear them talk about pausing. So rate cut odds right now are... It says here rate cut odds are 93.4%. Okay. What's Tomo? Term, what is it? Temporary overnight market operations? Temporary overnight market operations. Okay, and then, soft landing, that's a good one. Soft landing. And then pausing would be hawkish. So, hawkish stuff. Let's put hawkish stuff here. Hawkish. We'll put that here. And then that's neutral. So I'll put that right there. Labor break evens. No commitment on January. No comments. Labor market is softened but stable. That's fine. I'll put that right here. And some other hawkish stuff would be SEP moves GDP up and unemployment down, and then any suggestion of a pause. Any suggestion of pause. Okay? This would be hawkish market sell-off. / market sell-off. This is possible, by the way. This is there's a real possibility of this. I mean, that you get too much hawking. Like, we are expecting a hawkish cut. The odds of us getting like a dovish cut are very low. I mean, we did percentage odds this morning in the Meet Kevin Alpha report. But the odds of a hawkish / market sell-off do exist. Because if they move the SEP up on GDP and down on unemployment, it basically suggests pause. Suggests pause. And then any suggestion of a pause verbally would also not be great. But it's possible. What are your odds of a small rate cut but a massive one when Trump hires a new chairman? Well, I mean, it's a committee, right? So it's not just dependent on one person, which is the whole point. So, you know, we'll get our rate cut today. And then we'll know. We'll know when the data comes out. You know, next week's going to be a giant highlighter for next week. But anyway, yeah, no, this is great. Okay, somebody... let me save this really quick. Hold on. Save that bingo card, Fed. Let's save that as FOMC, December 2025. It's so weird. I remember doing the FOMC meeting in December of 2021. And we were like, oh, damn, man. That was hawkish. So, kind of weird. That was 4 years ago. That was a whole, like, presidential term ago, isn't it? You know, now we sit here and we get to look at nasty fixer-uppers that House Hack is buying and fixing up. You know, and House Hacks, like, who would have thought 4 years ago, you know, I'd have a company that people are investing in where we buy, you know, dumpster fires like this, moldy, nasty property that closes escrow today. Who would thought we would be buying stuff like this and releasing an AI app this month? I mean, we didn't think that 4 years ago. House Hack didn't even exist 4 years ago. It's incredible. So I think we're in a really cool spot. But man, the times have certainly evolved, huh? All right, good. So, okay, we saw the Howard Marks piece. Now let's go talk about, we got 23 minutes to go until the Fed. Let's see if the Doomers have anything juiced for us. Stuck in wait-and-see mode ahead of the Fed. Yep, totally understandable. Inside Meta's pivot. Okay, we saw that. 9 large U.S. banks engaged in debanking practices. Powell mentioned the Meet Kevin coupon code. Hell yeah. I think the coupon Santa reinvests. JP Morgan says everyone is expecting a 25 basis point cut. Of course. Of course. 9 large U.S. lenders made inappropriate distinctions among certain customers, the OCC said Wednesday, a finding that falls in line with Trump. Yeah. JP Morgan, Bank of America, Citi, Wells, all of them maintained policies that restricted banking services or required customers to go through escalated reviews and approvals. Yeah. Restricted access firms involved a range of sectors: oil, gas, coal, pensions, political action committees, digital asset companies. OCC is seeking to end those practices, demanding details. Some of the biggest banks have said they don't discriminate against customers based on political affiliations. People don't believe that. You know, I think a lot of people get debanked because of political affiliations. Still review. Thousands of complaints identified political and religious debanking. These banks should be sued. Yeah. All right, what else? Let's see if Nick T has anything for us. Somebody says, my buddy somehow got the impression House Hike started off as a flipping business. We haven't flipped a single property. We buy and hold, baby. Okay. Investors, bad, Fed projections. So, no. Well, we need Nick T. Well, Nick T should be in here, maybe. Maybe he's in the live blog. See latest update. Oh, BTC, I feel like just rocketed $1,000. Who bought? Wasn't it just at 92? Yeah, look at that. It just popped off. In the last 15 minutes. Look at that. Oh, rocket ship, baby. The Q's, on the other hand, relatively stable going into this. All right. So we got our bingo board. What happens if they come with a 50 basis point cut? Oh, it'd be so bullish, but they're not going to do that. Dr. Kevin, can I invest in House Hike since I'm from Taiwan? Yeah. No, we have people who invest from all over. We've got people from Germany, from Israel, from Canada, Italy. Like, people who invest from all over. Singapore. I don't know why, but I think the only places that can't invest are Bulgarians, Iranians, like North Koreans. It's like OFAC stuff. I don't understand it all. That's different pay grades. All right, so Nick T, the Fed vote you won't hear about. This is a cool picture. Who's this? Oh, Myron appears virtually with colleagues. Why is he virtual? Why is he not there? Like, how boring. And it's a giant computer screen or projector screen. Fed decision meeting comes with the usual pageantry, the statement, the press conference, the summary of economic projections, and the dot plot. But there's a quiet drama hiding in December projections that could be revealing. Ooh. Yeah, Bulgarians. Why? I have no idea. It's like an OFAC or OFAC thing. OFAC is like the terrorism. OFAC search thing, sanctions crap, Department of Treasury thing. Here, so you go in here, and there are specifically designated nationals and blocked persons list, and so you go into this OFAC website, and then it has like Iran on there, and other countries or whatever, and like your name could be listed on here, and countries are listed on here. I don't really understand. Mission: Office of Foreign Assets Control, the Department of Treasury enforces economic and trade sanctions based on U.S. policy. Yeah, whatever, bro. What about Russians? The Russians, I don't know. Somebody says Vlad from Robinhood is from Bulgaria. He might not be able to invest then. I'll have to tell him. Vlad follows me on X. I'll have to tweet him and tell him, sorry, Vlad, you can't invest in House Hack. You're from Bulgaria. And then he's going to be like, that's discrimination. And I'm going to go, I know. And that sucks. But that's what the government decides. JP Morgan's Michelle, we still see inflation coming down a bit. Expecting a 25 BP cut. Hassett, we saw he's pushing for a 50. Myron's probably pushing for a 50. All right, cool. So let's go back to, where's this Nick T Fed quiet stuff? Oh, and just to be clear, I should put the little disclaimer up. Remember, when I mentioned House Hack, it's not a solicitation to invest. Read the offering circular at househack.com, blah, blah, blah. Okay. 4 times a year, officials write down where they think rates should be at the end of the next few years based on the current economic outlook and appropriate monetary policy. But December is different. It's the only meeting where they also tell you what they thought was appropriate policy for the year that ended. Who cares? Nobody cares. The year's over, bro. This doesn't matter. In other words, do they agree with what just happened? Most years, this is a formality. Everyone writes down what the committee settled on. Okay, I'm trying to think of this. Okay, one sec. Okay, so most years, this is a formality. Everyone writes down whatever rate the committee settled on, but when it isn't, you get something fascinating. Soft descents. Okay. All right, soft dissents, got it. Officials who didn't vote against the decision quietly register that they would have done something different. Aha. Right. All 19 officials submit projections, but only 12 of them vote. So basically, you get to see the opinion of the non-voters comes through, right? So we'll write that down. Opinion of non-voters shows up. I mean, okay, that's fair. That's fair. I get that. All right. Okay. Last December, 4 participants wrote down a rate that is 25 basis points higher than where the committee went, essentially saying I wouldn't have cut. Okay. This year could be even messier. Right. That could be even more hawkish. You could get a lot. When projections drop at 2 p.m. Eastern, look at the 2025 column of the dot plot. So basically they're saying here. And then you could look at the range. So that 2025 column will still be there. Okay, yeah, that's interesting. Okay, all right, Nick T. Nick T, we're going somewhere. All right. If the committee cuts to a range between 3.5 and 3.75, as expected, anyone who dots 3.875 is quietly saying that they would have held. That's a good point. It's a really good point. You'll see all 19, in a unanimous decision, you'll see all 19 dots in the same place. This time, it could really show you how fragile consensus is. Ooh, juicy. Yeah, that is actually very interesting. Star Cloud transfer sale. Yeah, they have I think they have an H100 up there. So it'd probably be very small. Is it worth becoming an accredited investor? The cash I have on the side doesn't impact my personal finance. Well, it's easy to become an accredited investor. You pay like $30 for a form and send some paperwork in. Like, who does it? Oh, I forgot who does the accreditation that we always refer to. Anyway. All right. So what else do we have here? So, okay. Okay, what is this? Why is the dentist messaging me? It's a phone call. Oh, okay, I'll send it to Lauren. Don't these people know that I'm trying to cover the Fed over here? Like, this is ridiculous. There we go. You might want to call them to confirm. We're paying cash, baby. People, why do people leave voicemails? See, if they text, see, think about this. Like, if AI just sent me a damn text message, confirm you're good for your child's cavity filling tomorrow, I could be like, yes. And then the AI could be like, you don't have dental insurance, you're paying cash, right? And I'd be like, yes. But instead, I get a voicemail from somebody that, thank goodness, gets transcribed. Hi, I'm calling from so-and-so dentistry. I have you on the schedule for 9. Note that the insurance is inactive. If you could please give me a call back. Blah, blah, blah. So call me back. Like, I could text you this back. What a waste of human time. I don't understand. It's the same thing this morning. I got a call from an escrow company. They're like, Kevin, we see you've signed the closing statement. We see that you've wired the funds. We see you've signed the purchase agreement. And the closing date is today. Are you okay if we close the deal today? Why are you leaving me a voicemail? Yes. No shit. I hate it so much, man. Hate it. Freaking voicemails, man. I hate that crap. Like, I even say in my voicemail, text me. I'm not going to call you back. People still leave me a voicemail and say, please call me back. Somebody says, not too long until AI takes that job, don't worry. I cannot wait, man, because it is such a waste of money, man. Like, I don't want to be called. Don't call me. Like, there are some things you get on the phone with. Like, if I'm going to negotiate a deal, I get on the phone, okay? If I'm going to negotiate a contract, I'll do it on the phone or in person. But if you're calling me to ask me a stupid yes or no question, you're wasting my time. All right. So, what else? Qs, 30 bips. John Deere. Okay. She said, yeah, a lot of things are kind of red. Even Google dropped 30 bips right now. UiPath's on sale by a couple percent, but they're up like 30% or whatever in just the last week. So they're fine. Oh, DoorDash is on sale. I love this. I actually, like, I am salivating at the idea of buying DoorDash. But I don't own a single dollar of them. AI slops are getting dumber. AI slop is a whole nother issue. Anyway, all right. So, all right, here's the scoop. All right. So let's understand this reality here with the Fed. So let's get this banner out of the way. Okay. You know what? Why don't we put like a sexy banner up? Can we just have like a sexy like banner, maybe along the bottom? Can I spawn that in? Oh my God, that's hot. Kevin, don't use the Lord's name. Okay, I'm sorry. I apologize. I forgive. I repent. Anyway, all right, look. Here's the scoop, okay? Let's write this down. Let's go write down my predictions. Okay, so we're going to do Kevin's predictions, okay? So, Kevin's predicciones. And let's zoom in a little bit so it's nice and big. All right. I think we've got a 72-ish% chance that we get a hawkish cut data dependent. Okay. That's pretty baseline. I think we have a 25% chance that we get a hawkish cut and hawkish SEP. Okay, we already have the bingo sheet. We'll go through it in just a moment. Okay, hawkish SEP. This would be bad. This is bearish markets. Pause, etc. Could lead market to sell off, which isn't good. Okay, but the Fed knows that that's not good, and so that's why I think it's more likely we get a data-dependent hawkish cut. This is really a punt. This is a punt. Okay. And then I think there's a 3% chance of a Tom Lee face ripper. 3% chance of Tom Lee face ripper, bull crap, whatever. I don't have to say that. 3% chance of a Tom Lee face ripper, 25 BP in the bag, and dovish, Powell plus dovish summary of economic projections. I think that only has a 3% chance. Like that would just be a gift. This would be a gift. Would be a gift, and with weakening labor, probably the correct thing to do. Probably the correct move. But I don't know that we're going to get that. So, my outlook is the next 5 weeks are critical. Okay? Next 5 weeks are critical. Understand these things coming up. We have jobs on the 16th. Jobs on 16th. So 12-16 jobs. I have 12-18 expecting 50K for November. I've got 12-18 CPI. I've got let me go CPI schedule of releases. Oh, I already wrote this down once before, but that's okay. It is January 13th, and then BLS schedule of jobs releases. Wait, that's the schedule of consumer price index. BLS schedule of releases for the employment situation. January is 9th, Jan 9th. Okay, so 1/9 jobs December. And then we're doing 3.0, 3.1 core. And then we've got 113 CPI December. And that's going to be November. Okay. Let's show that on screen here. There you go. So these are the dates right here. Okay. This is what's critical in the next, this is the bottom line of this all, right? And you can get this in the Meet Kevin app. By the way, I do see those of you that are saying, hey, I'm not getting all the YouTube notifications. Make sure you download the Meet Kevin app. You get the Daily Wealth for free. You can customize your notifications for free. You get these the data tab, which is great. It's all in the app, literally. And you can change the color to whatever you want. It doesn't have to be this green color. You just go to preferences and pick the color you want. You could do, here, I'll change the color right now. There you go. Pick a different color, a neutral color like this. Pick the preferences. What do you want for your notifications or whatever? But it's all here. So, and customize your notifications, which we think is very useful. Anyway, so that's the expectation. The big thing that we're paying attention to is basically how hawkish are we getting, right? The big issue today. Okay, this is like the big cojones right here. This right here. How many of you are using Santa Reinvest coupon at meetkevin.com? Okay, no, that's not really a big issue. Or reinvest.co. I'll just call it househack.com. No, I'll tell you the real big issue. One sec. Let me just write that really quick. Santa Reinvest. Okay? No, it's actually, let's put that in here. Really big issue actually. So the big issue actually is how hawkish. Nick T says, watch D's 25 predictions on dots to see lack of consensus. I say watch SEP for 2026. Hawking would be up GDP, down unemployment, up CPI. Basically, should remove any cuts from 2026, absent changing data. This would be bad. This would potentially ruin Christmas for stocks until we get data that says the Fed needs to cut. The market really wants cuts. Okay, we like cuts. We don't want to hear pause. We want to hear QE. Those are the things we want. So that's the guide. Okay. Now the actual press statement is about to come out. So we'll cover that. As far as the bingo board, our bingo board is right here. So we've got on the bullish side, we're looking for no evidence of wage inflation. Inflation outside of tariffs is coming down as expected. We will see one-time price increases due to tariffs, but there's no evidence that tariff inflation has spread, becoming self-fulfilling. Inflation expectations are anchored, balance of risk, data dependent, dual mandate. We get a hawkish cut. Businesses that are hiring are struggling to find the right people. That's going to come up. I think we'll see January will be based on an assessment of 4 data releases in the next, 5 weeks. Duh. That's not a surprise. Expect the fog analogy, some fog, but it'll clear up as we get more data. We've been in a fog because of the government shutdown. A bonus, you could write here, fog of shutdown. Bonus mentions shutdown, right? The Schumer siesta. And half people get happy when I say Schumer siesta. Half the people get mad when I say Schumer siesta. But I always think it's really funny because I can go over here with my short shorts. I get my Schumer siesta hat. And then let's do a little preview, okay? So a little preview for us. The Federal Reserve is about to cut rates by 25 basis points. The big question is, how much are they gonna hawk to us? If they hawk to us a lot, the market might get sad. But we think there's only a 25% chance they're gonna hawk to us a lot. So we think instead, they'll just hawk to us a little. Either way, we'll find out in a minute. I'm out of coffee. This is a bad time to run out of coffee. Oh no. All right, 20 seconds, boys and girls. Here we go. I'm gonna read it out as it comes out. I'll just pull up the cues on the screen, I guess. All right, here we go, here we go. Okay, Fed, oh my God, median view of Fed funds rate by the end of the year, 3.1, yes, 3.1, that's good for next year. That's 2 cuts for next year. Good, that's good. Overnight interest rate cut by 25 basis points, extent and timing, additional policy, okay, extent and timing to describe its additional adjustments. I don't really know what that means. Judges, downside risks to employment have risen. Future reserve management purchases likely significantly reduced. Fine. Okay. GDP growth of 2.3 versus 1.8 in September. That's high. I was nervous about that. It's good for the economy, but that's a big move up. 2.3, man, that's a big move up. PCE, they reduced. Yes, that's good. That's good. They reduced their expectation for inflation. Unemployment, 4.4 at the end of 2026. That's bullish. That's good. That's bullish. It's bullish. You don't want to see a big spike in the unemployment rate. Okay. Implied 25 basis points of cut in 2026. Longer run view, 3% rate. Fine. That's interesting. It's been 3%. Median view of the Fed's funds rate, 3.1. So that's good. I've got vote in favor was 9-3 with Myron preferring a 50 basis point cut and Goolsbee and Schmid preferring no cut. So this was a 9-3 cut. I'll write that down really quickly. Fed cuts 25 BP with 9-3 vote. Myron wanted 50 BP. And then we've got Schmid and Goolsbee. Schmid and Goolsbee wanted no cut. Bump it. Okay. Then I've got ends operational limit on overnight standing repo. Pace of future reserve management significantly reduced. Treasury bill buying to be elevated for the next few months. There's Tomo. That's Tomo. Oh, okay. Hold on. Elevated 3 minutes. Fed first reserve management purchase operation to be $40 billion in treasury bills. There it is. Tomo. Bill buying to be elevated for the next few months. Attentive to risks on both sides of the dual mandate. Judges that downside risks to employment have risen. Uncertainty remains elevated. Okay. Expanding at a moderate pace. Job gains have slowed. Unemployment rate has edged up. Okay, that covers all of it. Let's actually get the statement now. And overall, so far, so good. It's not like a big rug pull. It's broadly in line with expectations. It's not a dovish, right? So far, this is not dovish, so it's not the 3% chance so far. But we're going to look at this SEP because this is what we wrote on the SEP. I actually said bump here. I looked at 2%. They went to 2.3%. And they kept the unemployment rate stable, but they kept that. Dude, I said 3.1 and they went 3.1. Let's go, dude. Let's go. That price is in the 2 cuts. That's exactly what we wrote down. Okay, perfect. So let's go look. The one thing that's a problem is pumping that GDP up that high is a little hawkish. So, because it basically says, why do we need a cut anymore? If GDP is doing so well, we're so far away from, a recession if they're pumping this up. So that is the hawkish part of this. So now we have to deal with the hawkish part. The FOMC SEP December 2025 projections. Okay, so the hawkish part right here. Shout out to the Reinvest AI coming out this month. Go to househack.com or reinvest.co to learn more. Okay, this is the hawkish part right here. See right here? I predicted 2. So let's make this green, just so we have that ready for next time. And let's drop that to like 10. Okay, so I put 2 here. And this is definitely more hawkish than that. That is hawkish. Okay, so they hawked. This is also hawk. This, it's stable. This stable, which is somewhat hawkish. And they actually see the unemployment rate coming down next year. Ah, crap. That's hawkish. Down unemployment is hawkish, ironically, for more cuts, right? It's like bullish the economy, but that's hawkish. I've got the alignment on rates. You could see the dissension that Nick T is talking about here because we ended up here. This is what we predict. Wait a sec. Fed funds rate. Oh, longer. Okay, I'm a little confused by that. We'll have to look at that in just a second. But 3.4 for 26. That's not what it said here, is it? End of 2026. Oh, no, 3.4 and then 3.1, 3.1. Wait a second. If that stays at 3.4, how is there any more of a cut here? So this is hawkish. Where's our 2026 cutting? I don't see cutting in here. Let me look at this one. So, interesting. Because we got our 25 cut. We just cut to basically that 3.6 level. I mean, there's like 1 cut in there, right? Because right now, we sit at, let's drop this in here. We're at 3.5 to 3.75. So 3.6 is where we sit, is where we are. Okay, yeah, so that's 3.6. That's in alignment. That's fine. Okay, so you've got 1 cut in there. 1 cut for 26. Market wanted 2. 1 cut for 2026. Market wanted 2. So that's a little hawkish. And then that kind of kills the January cut, unfortunately. Okay. Core inflation coming down. We were looking at that moving up to 2.7. They moved that down, which is actually good, but it's also, that's actually dovish. Inflation down is dovish. That's good. So a little bit of a mixed bag here. Let's see what the ranges were on the dots. So the ranges are over here on the far right. The range is always interesting because you could look at the GDP range and they've basically removed recession. Look at this. The person who was bearish, yeah, that's September. Yeah, look at this right here. For 2026, the low-end forecaster revised up. The bear revised up. The recession or slow growth bear revised up. Think about that for a moment. Does that make sense, right? So you had somebody who's like, oh, GDP might only be 1.5% next year. No, it got revised up. Okay, that's hawkish. Okay, all right. So let's write that down. Revised up. That's hawkish. I've got the unemployment rate category also revised. No, I mean, you didn't get the upper end change, so nothing changed here. Inflation, nothing really changed here other than it went down a little bit. So that's fine. Okay. And then, of course, the longer run, they don't really have any color into this anyway. Okay. So then, let's go look at the actual dots. So they're pretty tight. So here you go. These are the actual dots, basically showing we're getting to neutral, right? Getting to where they want to be. Let's write that down. Getting to where they want to be. And looks like everyone wants to settle around 3%, which says we have, 1 to 2 cuts. We have 2 cuts to go. 2 cuts to go, only one for 2026 built in. Okay. Let's see here. Cool. Okay, hold on. I'm getting some spammers in the comments here. Let's listen in over here for a moment. I'm going to put this on members
the
only.
short end. But I do think this is, more dovish short term, but still pretty hawkish long term, because if Stephen's reading of this is right, they've upped their estimate of GDP growth next year by a lot. We've got all these income tax refunds that are going to kick in the first half.
Blah, blah, blah. Okay, good. Yeah, so here are the cues. Going for 627. And we got Tesla's now moved up. I've got Bitcoin's pretty stable. I've got DoorDash is starting to rise. I've got Circle's rising. Path rising. Netflix not doing anything. AM Dizzle's coming up. Wow. Okay. All right. Very well. So let's go. Yeah, DoorDash. Let's go watch. Okay, so. Okay. Let's go into here again. Okay. So, the big thing now, we have the summary of economic projections. What we need to see is Powell's guidance on potentially a pause. That's a risk factor. So, let's consider that. Powell potentially to signal a pause here, because if he signals a pause, it basically gives them the latitude to wait for data, right? So we get our cut, but this leans hawkish, right? This is positive for the economy, but leans hawkish. Let's write that down over here. So that way y'all have that data in the actual app. And let's throw in where we're leaning here in terms of the odds. Obviously, we're not getting dove. I'm going to write down this 25 BP cut. We've got the 9-3 vote. Myron wanted 50. Schmid and Goolsby wanted 0. And then what this really says, this SEP says economy is fine. Okay, economy is growing again. Economy is fine. Economy back to growth, more growth next year. Economy more growth in 2026. It sort of probably incorporates tax cuts, fiscal spending, and lower rates, right? Maybe more borrowing, more AI. It incorporates stable unemployment and falling prices. Well, falling inflation, which isn't falling prices because that's deflation. Falling inflation. So overall, like, it's hawkish, but it's bullish on the economy, right? So hawkish statement, but it's bullish the economy. Even your recession forecaster or slower growth forecaster revised up to 2% GDP growth. I shouldn't say recession forecaster. I just say your slower growth forecaster revised up. We saw that in the revision over here in the 2026 range. So this is good. This is broadly pretty good. Let's listen to Steve for a moment.
About the balance sheet expectations, and it was for purchases to begin again in April. So this is quite a bit earlier, and for purchases to average just about 28 or 30 billion. So this is more than that. So on that front, for sure, I would also point out that when I'm looking at the immediate reaction of the market, it's a little bit more dovish in terms of that next rate cut. We had it more fully priced in for June before the statement came out, and now it's about a 57, 58% probability for April. That's going to bounce around. And all of that said, this entire discussion, I would point out, may go out the window next week when we get October and November employment numbers, as well as some inflation numbers, and we'll figure out if the Fed made the right call here and whether or not the forecast is worth either the paper.
Yeah, we'll throw it away next week when we get the actual data, right?
That's an excellent point.
Yeah, somebody writes, a recession was the biggest risk, therefore Fed is bullish. Yes, I mean, I agree with that. So, like, the Fed's basically saying, Fed saying, with employment stable, we don't see recession. That is bullish GDP. That's bullish GDP. It's selfishly bullish. House hack / reinvest IPO. It's bullish AI. It's bullish stonks. It's just bullish everything, right? Like, recession is painful. Nobody wants that. Recession equals long phase of job loss, AI rejecting new hiring, basically. It's a generation of pain. It's not good. Right. So overall, this is a good statement. Obviously, the key risk factor would be a cliff. Key risk factor is some form of labor cliff, which is usually evidenced by layoffs skyrocketing or hiring stalling completely. However, October JOLTS report indicated higher than expected job openings. Is it possible that JOLTS report is just showing seasonal hiring? Maybe. I mean, maybe we could look at it before Powell comes. JOLTS report, because that's kind of interesting. Let's go find out. So if I jump over to the actual JOLTS, job openings. Okay. Let's delete all this crap. What is this? So this was JOLTS yesterday. 7.7 million. Job openings decreased in the federal government. See table 1. Job openings. Okay, so where were the jobs? Total job openings for October. Preliminary read for October. Total 7.6 mil. Expectation was for that to decline. Okay. And then where did the bounce come from? Professional business services went red. I've got a little bit of a bounce in private education and healthcare services. Leisure and hospitality actually had a decline from the last month. Government had a decline from the last month. State and local popped a little bit. So where did those jobs come from? Trades, transportation, and utilities. This could be holiday shipping. This is seasonally adjusted growth in trade, transportations, and utilities. I mean, some of this also could be AI, data center stuff, wholesale trade, retail trade. Utilities aspect of that was smaller. A smaller portion of that was utilities. financial activities actually plummet in job openings for financial activities on a seasonal adjusted basis. That's probably because of AI right here, right? Like finance and insurance, you're seeing a plummet in finance and insurance because you'd rather just use AI. The hell? So it seems like a lot of these job hiring was in trade, retail trade, wholesale trade. Trying to see where else. Manufacturing, a little bit of a move up, so that's good, but it could be a little misleading. So I guess we'll find out. Okay, all right. So let's go see. Qs right now are basically flat on the Qs. You still got Bitcoin down about 4%. We did notice that Bitcoin was down about 4% after earnings yesterday, and we covered that already. DoorDash still down about 4%. MP Materials still bleeding. That's not a surprise. Nvidia is having trouble trying to actually get back to green here. There's a lot of rejection here. I've got what else do we have here? Google's up 35 bips. Nice move after the dot there. Let's see what Rick's got.
Today's $22 billion 30-year bond auction because of the Fed meeting. We'll have that tomorrow. But I think it'll be very interesting to see how that demand goes. And then finally, Steve Leisman pointed to some of the percentages and probabilities in Fed fund futures. And I always put a word of caution that these things are just markets. They change moment to moment. But the next meeting that even is close to the possibility of an ease, anything over 50%, that would be the June 17th meeting at the moment. Back to you.
All right, Rick, we really appreciate it. And I think it's a good point to make that as this kind of settles in for the past 20 minutes, markets are looking a little bit more on the bond side like they were pre-decision, although equities are still near session highs. Let's talk more about that now with Jeff Kilberg. He's the founder and CEO of KKM Financial. What do you say, sir? Welcome.
Well, Kelly, kind of a surprise. Everyone was looking for a cut in rates, more hawkish. And we actually got more. If you think about that, $40 billion they're going to start purchasing in just a couple of days. That's annualized.
Those are T-bills
Of new QE. So with a $6.5
QE.
trillion balance sheet, I think a lot of folks were surprised. That was the initial reaction in equities. But you're seeing a little bit of a shift here, and we're waiting for the presser. But I think this was much more dovish. And I think Fed Chairman Powell is keeping his job for another month because that's the one that we haven't talked about yet. And I think the long end of the curve is not pricing the fact that he may not be here in May of 2026 if President Trump has his way.
So right when the decision came out, you were standing right there, and you heard me say, this is the son of QE, or QE light. Because to me...
Well, QE light, I mean, we talked about this. It's TOMO is what it is. It's TOMO. It's not QE, it's TOMO. This is TOMO we expected. TOMO we expected. So what it is, it's overnight liquidity support. And that's the important thing to remember. This is overnight liquidity support, which reduces the risk of a shock to the financial markets / banking / private credit. It's not bearish. It's actually supportive of lending, which is supportive of risk. What is TOMO? All right, I'm gonna write it down. TOMO from yesterday's video, which we explained. Yesterday's video, temporary open market operations. Gave a heads up. TOMO, no, it doesn't, Sammy. What is he, your brother? So this is very different from QE because it gives this impression of long-term bond buying, but it's not. It's very short-term bond buying. And it's a liquidity support for private credit. Okay, good. So let's go see. We've got Powell coming out in 8 minutes.
So the real question is whether they intend to do anything beyond kind of keeping up with the level of GDP. They're kind of...
No, QE is... Okay, QE is just bond repurchases. What's the difference? It's time. Okay, so I'll write this down. It's time. The difference is time. The difference is time. QE equals long-term bond buying, such as 5, 10, 20-year treasury bonds and holding them. So the money permanently, effectively, flows into the economy, okay? TOMO equals overnight lending, but unwinding of that lending every day. So the money doesn't permanently show up in the economy. It just helps banks cover their overnight bills. Permanently show up in the economy. There we go. So there's a huge difference between QE and TOMO. However, they both help, right? QE is really bullish because you're literally expanding the money supply, okay? So QE very bullish because it expands the money supply basically permanently, okay? QT shrinks the money supply basically permanently. And then TOMO makes no difference. TOMO basically, TOMO tonight expands it and tomorrow shrinks it. So it really has no permanent inflow effect. That's the explanation. No permanent effect. However, why it's seen as bullish is that it reduces shock risks in the economy. It's like a capacitor, shock absorber. I think that's the way to look at that, right? Cool. So I think that's somewhat useful. All right, great. Okay, good. So now we wait for Powie Wowie. The Q's had some of their enthusiasm. Now we gotta wait to see what Powie Wowie says. We have our, somebody says stop wasting time answering dumb basic questions. People get into this mindset of like, it can only be one way or it means one thing. It's so I try to break it down and explain to folks. So like, I'm not trying to be some bear here. You know, I think sometimes people hear like, yeah, Kevin doesn't like the perma bull Tom Lee. Oh, that means he's a bear. No, that's not what I'm saying. I'm saying there's context. There are real risks in the economy. And this is why I say I don't have personal debt. Househack, my company, does not have any bank debt. And we think people should be diversified and not take on massive risks because the economy is at a teetering point. But the Federal Reserve is saying things are good. But then again, how much do we trust that? Because when things, like if they said things were going to go bad, things would instantly self-fulfill and go bad. So you have to take everything with a grain of salt. All right, so let's look at the 10-year Treasury yield just came down a little bit. Wow, the 10-2 just popped up to 60. Wow, look at that. That's very interesting. Yeah, 60 on the 10-2 spread right now. Okay, so now let's get to our bingo sheet. So this is our bingo sheet. So our bingo sheet indicates that we expect that there are things that are bullish that Powell could say, and there are things that are bearish Powell could say. And so especially if you're trading, you want to pay attention to this kind of stuff. But what you've got is on the bullish side for the economy, but bearish on fewer rate cuts, you've got this left column. Let me start with the dovish stuff. So Powell going dovish, which would be good for the stock market, would be talking about the analogy of fog, talking about how we've got to wait for clear data next week. Labor force participation could rise suddenly, which would be bad. You've got unclear if AI will aid the labor market. Tariffs are blocking Chinese deflation, right? Eventually that deflation will show up. No comments on the next share rate. These are the more dovish things. And any kind of talk about a pause or a suggestion of a pause verbally is bad. I mean, they're kind of implying a pause already in the summary of economic projections, which, isn't great. The summary of economic projections moves GDP up and unemployment rate down, suggests a pause. See, we wrote this before the summary of economic projections right here. And what I got was down unemployment rate, up GDP a lot more than I thought. So this already happened. So we can already check this off on our bingo board. because that's exactly what happened. Obviously, we got some basics in here, some quotes that he might say, the dual mandate, hawkish cut. I mean, that's pretty much what we're going to get, but we're going to see what Powell says. Businesses are struggling to find talent who are hiring. We'll see. Any kind of talk about potentially the JOLTS data being strong because of seasonal hiring or like people expecting a really good holiday season, that could be short-sighted, because what if we end up getting some kind of reversal of that trend? That's always the risk, because we looked at the JOLTS data, and the JOLTS data tells us that a lot of this was in trade, and trade could be short term. Okay, cool. Okay, so what do we got over here?
206. So you see the potential for this market to take this and run with it in a dovish direction, but it's going to be really important how Powell emphasizes whether the...
No, this is a brand new bingo board. I literally just made this bingo board 20 minutes ago. It's not an old bingo board. It's from 20 minutes ago. It's just, I said, if the SEP comes out with GDP up and unemployment down, it suggests a pause. The SEP came out 20 minutes ago. Well, so the bingo board was like from 45 minutes ago, and the SEP came out 29 minutes ago, right? Anyway.
25 base rate cut.
So to your point about 20 times out of 20 times, by my math.
Where does this put this on a soft landing? It's good. All this stuff is bullish soft landing. None of, like, I'll write that right here. And we should say he's going to say good afternoon, right? Bullish soft landing. Let's quickly add to the bingo board. On time and says good afternoon. Yeah, that's what we need. Okay. All right, so you can see it quickly. I put it on here. On time, it says good afternoon. All right, here we go. So he'll be out in about 30 seconds. Keep in mind, if you want to use coupon code SANTA-REINVEST, you can get lifetime access to my startup's artificial intelligence. That's coming out this month. And all of the updates are yours included. You pay once. There won't be any monthly fees. Obviously, when all the products are out, we'll have a monthly fee, and we'll have a SaaS product that we hope we can IPO. Here he is. All right, go check it out at househack.com.
There is Jerome Powell. Let's listen into the Fed chair.
Good afternoon.
Yes.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem.
Yep.
But with downside risks to employment having risen in recent months, the balance of risks has shifted.
Boom!
Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate.
Dual mandate, yes!
Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions.
Bump it!
In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets.
Look at that rejection on the Qs.
Standing repurchase agreements.
Perfect!
Operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments in September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate.
Guy frickin' ruined it! Had to ask.
For next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so,
how do I not have bingo?
As our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several
soft dissents
or recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor. in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the
jobs report.
Household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal.
There he is, Nick T.
Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation.
Bullish.
As tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation.
Wait and see.
We're going to start to see the data, and it'll tell us whether we were right or not.
Ruined my birthday. I wanted a rate cut Jan 28th. That's my birthday. I don't think I'm going to get it. No birthday cut for
Claire
Kevin.
Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew. Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew.
Nailed it!
We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get 3
Ask
questions.
a better question.
Just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
It's so weird because he just said we're growing at negative 20K jobs, but he's hawking. It's really weird.
The inflation expectations has come down in your SEP report.
So weird.
Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. Are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got it when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think it's I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing. And it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way, that's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. But really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know. But it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think
this may be different.
This could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda. Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what? On
the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people.
Rich become richer.
Housing supply is low.
Yep.
Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris. Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever, And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy. But we've moved back our policy back down to where it's not. It's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right, let's do the summary. Folks, if you have not yet, check out our AI at househack.com, and of course, check out our courses at meetkevin.com. But for now, let us do the summary. Boy, it went even better than we could have asked for. So let's get the party started. Here we go. All right. Well, boys and girls, that went a whole lot better than expected. We got things we weren't even expecting we were gonna get. We pretty much got Powell going soft landing in the bag, and in the meantime, we's gonna cut until we get it. That's kind of what we got, but there's obviously a whole lot more detail because he also sort of told us that we're paused. We also heard that jobs are potentially at negative 20,000 jobs per month, and that we're just going to ignore the December reports, and that we are printing money for temporary open market operations. How the hell do we reconcile all of that? Because these are all things we just heard. We literally heard Powell tell us we are not going to let monetary policy weigh on the jobs market. In other words, if we need to cut even more to protect the jobs market, we will. This was a crazy Fed meeting because there's so much to break down out of all of this. So let's put it all together. All right, first, we got a cut from the Federal Reserve. We got strong economy, GDP, and unemployment guide in the summary of economic projections. And we got a really dovish Jerome Powell suggesting that jobs could be plummeting to the tune of 20,000 jobs per month because he thinks the Bureau of Labor Statistics is overstating the jobs report by 60,000 jobs per month, which is the reason that they gave for cutting 25 basis points. He says that the Fed voted on a vote of 3-9. So 3 did not vote for this 25 cut and 9 did. We got Goolsbee and Schmid going for 0 and Myron wanting 50. So he wanted a bigger cut, which is also what Hassett said earlier, that we should be pushing for a 50 cut. But I want to get to the most interesting stuff first, which is that Powell told us that this jobs market is the big concern, and they will not let policy stand in the way of the jobs market stabilizing. They say that the jobs market weakened more than they expected, which contributed to this cut. And while they think that tariff effects are basically going to expire in Q1, in other words, peak out, so as long as we don't get any new tariff announcements, we're going to peak out on inflation in the first quarter, and then it's down on inflation from there, and we should be able to support the jobs market. Now, he says we're at neutral now, which is a little bit hawkish, right? Because it's like, wait, so no more cuts? But he's also basically telling you, hey, look, no more cuts. But if the job market actually keeps weakening like this, we're going to keep cutting and printing, basically. So we've got to break this down. He makes it clear towards the end of his press conference that the labor market has significant downside risk. And it's almost like he read the Howard Marks piece that we were reviewing this morning in the live stream, where he says that if the job market turns down, this is going to be a very unique downturn because it means that AI, the very thing that induces the downturn, might also prevent the recovery. Because usually when you have innovation like cars or radio, or you have a recession, you create more jobs after the innovation or the downturn. But this innovation-led potential downturn could actually eat the very jobs that would cause and keep you in a depressionary state. And so he's basically telling the market, hey, listen, guys, right now we think we're good, but we are ready to run this freaking money printer. We are so freaking ready. And this is broadly bullish. I think this is why markets are like, yes, we're going up. We broke right through 627. This morning in the Alpha report, we gave it a 78% chance of a bullish outcome today. We were moderately bullish to very bullish. A dovish Powell, in fairness, was not on the bingo board. It was a possibility, but it literally wasn't on the bingo board. This is our bingo board. And if you look at the different segments that we didn't nail here, we didn't actually get talk about a stable jobs market because we actually got talk that the labor market has not stabilized and that they are trying to stabilize it and that it's actually growing negative. See, that's why I put a big orange check X right here, because I wrote that Powell would tell us something like labor market break-evens around 0 to 20K. Data suggests we're at break-even. That's not what he said. He actually said we're likely below break-evens right now, which is bullish. But we did get a hawkish summary of economic projections. So this is kind of like a weird thing to reconcile, right? But if you look at the summary of economic projections, we got GDP growth that moved from a projection of 1.8% in September right here to 2.3. Now, Powell says some of that is because of the government shutdown. This should have been like 1.9 and 2.1, he says. But basically, really writing up GDP. That's technically bullish soft landing, hawkish rate cuts, right? I guess 2% on that, mind you. They kept unemployment at stable to down, which is hawkish, and the base case scenario is soft landing, no recession. In fact, if you go over here to the range, you can actually see they basically removed the negative potential for GDP. You can see that the person who in September was betting that GDP would be as low as 1.5% actually revised up to 2%, which is actually really remarkable because it means that the consensus at everyone who put together, all 19 members, not the voting 12, all 19 members of the Fed who put together this SEP, they're like, look, our base case is bullish, man. This economy, bullish. We're ready to cut and print if we need to for job cuts, but we are potentially pausing right now. Jerome Powell's first question, mind you, was, hey, are you basically saying pause? And Powell's response is, yes. And then, of course, we'll be data dependent. Now, of course, we're getting data next week, which Jerome Powell was also asked about. But that's where things got weird because Jerome Powell basically looked at the data and said, don't think about it the way you're thinking about this. And this is weird because I'm like, before this meeting, I wrote the following down. I wrote down this. See, I wrote down that we've got a jobs report coming out December 16th. We've got it where we're expecting 50,000 jobs, which according to the Fed would be negative 10,000. Okay, because they're taking 60 off of those. Then you've got CPI on the 18th. Then you've got jobs on the 9th again. And then you've got CPI again on the 13th. That's January, right? Now, what's crazy, what Fed did is he literally put an asterisk on this. Jerome Powell said that the reports that we get in December for November, we're going to have to, quote, look at very closely because the way they collect the data during a government shutdown isn't good. In other words, you can't trust that data that you're getting. So Powell basically said, look, we're on hold. We can't trust the data that we're getting for November because of the government shutdown and the collection actions that failed because of the government shutdown the first 2 weeks of November and, first 12 days of November and obviously all of October, the longest shutdown in history. And so he's kind of saying, like, we're just going to ignore that. We're going to go to January and we'll see what we get with the data releases that come in January. Now, the next meeting is on my birthday, January 28th. Right now, markets are expecting about a 25% chance of a cut, which is the same spot where we were before all of this release. Now, again, how is that possible? Because we got this hawkish summary of economic projections. It was hawkish. The market's like, oh, damn, we're on pause and we're hawking on the summary of economic projections. Odds of a rate cut in January, I was watching them, dropped to like 12%. And as soon as Powell said, don't trust the data that's coming out, we are ready to print if we need to, and the jobs market is moving below break even right now, and this is going to be really bad if we go into a downturn. As soon as he said that, saying we've got the tools to support the labor market, we're not going to stand in the way of the labor market. As soon as he said that, the odds of a rate cut for January 28th went right back up to 25%. Watched it happen live. It was remarkable. So we did get bingo, but we actually got bingo on things that are good for inflation, right? No evidence of concerning level of wage inflation. He referenced the ECI. Literally what we wrote down is what he did. Inflation outside of tariffs coming down as expected. He said that. We will see one-time overtime price increases due to tariffs. He said that. No evidence inflation has spread to other services or becoming self-fulfilling. He said that. Inflation expectations are anchored. He said that, right? Like all of those things that we anticipated in that column, which are good for the economy. Inflation coming down, great. But he gave us even more. Not only did he give us the beautiful, delicious Santa Reinvests coupon code for the alpha membership at meetkevin.com, where we made our plan this morning and released it every morning when the market's open, but also our AI at househack.com, or reinvest.co, it's the same company. He also gave us this blessing that said, listen, if we need to cut, we're ready to. And inflation's going to peak in January. he said Q1 in fairness. He thinks that inflation will peak in Q1 and that we'll be sort of on a downtrend from there, in part because of the housing sector, because housing rental inflation has basically zeroed out. Now, he did also talk about housing, and he was asked, hey, you're lowering rates, it's going to be good for housing, right? And he's like, no. The problem with housing is we don't have enough housing, and that keeps housing prices elevated, is essentially what he's saying. He says the problem is it's not something the Fed can control. You need to build more housing to actually get prices to come down. This is one of the reasons I love investing in housing in areas where they don't build houses. That's why here's a property we literally, during the Fed presser, I got an email, we just closed on this. Look at this. Nasty, hoarder, gross, moldy, disgusting disaster. Nobody wants to live in this. Nobody should live in this. No human deserves to live in this filth. That's why we buy it, we fix it up, and we gain value by doing that, right? We provide a good or a service, a quality rental that somebody can rent from, and we make this beautiful. That's our job. That's the basis of my real estate startup, right? The real estate AI that we're doing is a huge bonus that obviously could be a massive game changer. It is why I want a soft landing. Just to be fully transparent, I would love nothing more than a soft landing, because if we can soft land, it means we can IPO sooner. But Jerome Powell is like, listen, the labor market is doing way worse. And this is the first time I've actually seen Jerome Powell go, not only is the labor market doing worse than we anticipate and expect, with potentially being at negative 20,000, but we need to do everything to avoid a sharper downturn from employment happening. That's why we're at neutral rates, and if we need to move lower, we will. But for now, we're on pause. That's the easiest way to reconcile this. So let me make sure I got everything covered here, because there's a lot. Tomo. We need to talk about Tomo. Okay. A lot of people are going to be really confused by Tomo. Donald Trump, by the way, right now saying the Fed rate cut should have been double. We know that's what Hassett said this morning. Hassett is basically Donald Trump's shill. So it's not a surprise that Trump is saying it should have been double. And this morning, Kevin Hassett is like, a 3% GDP is a low ball. We have an AI boom going on with 18 trillion in new factories. And the Fed will need more cuts. We actually support a 50 basis point cut, although a small 25 basis point cut is in the right direction. That's what Hassett said this morning. Not a surprise that Trump is reiterating it, because Trump probably said it to Hassett. Hassett went on Fox News and yapped it. Okay, that's how the game is played. Okay, learn the rules of the game and play the game. Eco 101, basically. Okay, now, regarding Tomo, a lot of people are going to get confused by what Tomo really even is. And that's okay. I'm going to explain Tomo very clearly. So Tomo is basically overnight lending. Think about it like injecting money into the economy, but then taking it right back out the next day. It's very short-term liquidity used to manipulate the overnight funding rate. That's it. It is not quantitative easing, because the money doesn't actually ease into the market. Okay, a lot of people, these people, there are some people that I won't name by name, but that I really don't have a lot of respect for, because they never look at things in a nuanced manner. They can only see things that are beneficial to their own. I'm not going to get into it. Anyway, but basically I heard somebody go, ending QT is basically the same as QE. It's like, no, it's not. Quantitative easing is the expansion of the money supply in a permanent manner by permanently running the money printer to generate reserves that show up at bank balance sheets and at institutions that can then be lent out into the economy. That is long-term 5, 10, 20, 30-year treasury bond funding. Stays in the economy for a while. That's what we got after COVID. Tomo, or the temporary open market operations, is just a fancy way of saying, listen, we're ending QT, and as a result of that, we're going to be buying some short-term treasury bills, like 1-monthers or 6-monthers or whatever, just to keep liquidity moving. But it is also bullish. So both QE is bullish, ending QT is bullish, and Tomo is bullish. Why is it bullish? Not because you're expanding the money supply, but because you are reducing a risk of a private credit shock. So yes, bottom line, all three of those things are bullish, right? Ending QT, QE, which we're not getting right now, obviously also bullish, and Tomo, all bullish. Why? Again, reducing shock risk, which is important, because the 10-2 treasury yield right now is jumping to 61 bips. I honestly think that is because the job market, or the bond market, is going, oh crap. The Federal Reserve might have to cut rates even more in the short term to prop up the labor market, because Jerome Powell is literally telling you, don't trust the data, and, while we're on pause now, we're ready to print. Okay, that's Tomo. What else? So far, we've got disinflation continuing. We've got Tomo up to $40 billion in December and may remain elevated. That was more bullish than we anticipated. That was more printing overnight, which gets vacuumed up again, than we anticipated, which is good. We also heard that the consumer keeps spending, but that's mostly in the upper income level. That's fine. My ski slope cup right here. Going skiing next week. Everyone agrees the labor market has softened. The question is, what's the biggest risk? We have to be careful in the assessment of the household data. The data may be distorted. Data was not correctly collected in October, November. And in my opinion, this is basically very messy. He's saying don't trust the data. And then he says we need to be very skeptical of this data coming out in the next data set. Great. You did see 3 people at the Fed committee project rates at 3.9, which suggests a rate hike. Jerome Powell says a rate hike is not the base case scenario at all right now. Unfortunately, there's no evidence of a sharper downturn in employment with rates at neutral, but we have very real risks to pay attention to. Job creation is negative. And he says we need to watch the situation very carefully. We do not want to push down on job creation. We do not want to push this labor market down. That's huge. Then he got into a little bit of like how great AI could be from a personal productivity point of view, but obviously remains to be seen what it's going to do for the economy, right? For actual labor market. And so this is where this is broadly a bullish reaction, I think, is appropriate here, because bottom line, if I've had to put this all into one line, I would say the Federal Reserve says the economy is soft landing, and if there's any hiccup that says the jobs market's going to roll over, they are ready to run that money printer. They've got a jet engine attached to the money printer, and they're like, just say the word, baby, just say the word, because we will run that printer. We will run that printer faster than a Mach 2 jet engine from Boom. If you saw that news, the turbines for AI now, it's crazy. And I get it. It's great. There are cool things. And we're just really getting into the AI productivity phase. I hate always bringing this up because I feel like people think, I'm shilling this. It's not a solicitation. I should put the not a solicitation banner up, read the disclosures. But I think the next phase of AI is the actual productivity stuff, where when we release this feature, you're going to be able to take a picture of a home or your bathroom or your kitchen or your house or whatever, and we'll tell you if you spend X dollars, your net worth could move by Y. That formula function for doing investments and for doing renovations is a game changer for real estate AI. It's a game changer for construction. It actually says if you spend money on XYZ, it could make you money. In my opinion, the AI would come and say, hey, we're going to put together an estimate of how much it costs to renovate this for you, all automatically with our renovation AI. And then we're going to look at what this property is selling for versus what we actually think it's worth, fixed up as a beautiful property, a property that's not disgusting and a hoarder mess. And I mean, look at this. This is terrible, right? And what does the AI say? That our net worth is going to increase by remodeling these bathrooms or this kitchen. We believe the answer is going to be a lot, to the tune of $100,000 to $120,000 or more. I mean, who wants to use this kitchen or this bathroom, right? This is disgusting. Look at this. Look at the rust over here. But do you know how much that medicine cabinet costs us? $30, right? This is what we're trying to teach with our real estate artificial intelligence. Look how nasty that is. Ugh. This is why you don't have enough supply, because in Democrat-run states where this house, for example, is, they don't build new homes. So you rely on people with the balls to go deal with, Stachybotrys or whatever the hell this black mildew is. We don't like to use the other M word. And provide housing for people, right? It's a lot to do. But anyway, that's my bias, is that we are going to go into some form of productive form of AI phase. But, if labor falls off a cliff, we got problems. But the good news is Powell's here to tell us it's all going to be okay. We're going to print. Now, is this time really going to be different? Is it all going to be okay? Well, I guess we'll find out. All I know is If you want to see the stocks I'm buying, check out the Alpha Report. Get it every single morning before the market is open. Use that coupon code SANTA-REINVEST at meetkevin.com or join our Reinvest AI at reinvest.co. And folks, we'll see you in the next one. So with that, thank you, Jerome Powell, for going bullish today. It's exactly what we wanted to hear, and cheers to everyone. I hope you make lots of money out there, and I wish everyone the best. I'm going to make more coffee now. See ya!